Business. Asia was a little less soft than had been expected. It was Americas to Europe as well, spending heavily on Cartier. So we look at the broader lift around luxury and the read across there. Chips TSMC coming out with profits up, what, 57% in terms of profits, and the spend in CapEx up to $42 billion US dollars. Universal Music Group looking potentially for a share sale in the US as well. So we're watching Universal Music Group, the at the open guy.
Yep, time for the opening trade. Let's take a look at the numbers. I would imagine that we're going to see a big boost coming out of the luxury space into the CAC Caron today, so look for that market maybe to outperform, as we've already suggested. You've got Rio to factor into the FTSE 100. Sterling also something you need to be thinking about as well, as to how you kind of relate the inflation, GDP, to the gilt story, to the sterling story. All of that obviously relevant for the FTSE 100, which is now up by 0.4%. Continue to watch what is happening in oil as well. That's a relevant market to the FTSE 100. So the FTSE's up by around 0.6%. We're expecting significantly more out of the CAC Caron. The Richemont numbers providing another nice little boost for this sector. You've already seen a number of other smaller brands out over the last few days delivering quite nice numbers, and I wonder whether that is going to be today just gives an added momentum to that story, despite the maybe more bleak macro top-down picture that we are watching. So the IBEX up by 0.6%. The overall market up by around 0.6%. We don't have a price yet for the CAC Caron, but Tom's going to talk about some of the individual sectors and names, and I suspect while we're doing that, we'll see that market open up and we'll get a better idea of what is happening in luxury, Tom.
Well, technology for now is ripping. Luxury will get a lift as well. Technology up more than 2% as a sector. That, again, the read across from TSMC, a reminder that the spend around CapEx, they are bullish. The outlook in terms of CapEx up to $42 billion. That suggests they see their clients, they see the demand around churning out more of those AI chips will be sustained through this year. The profits of TSMC were up 57%. So we're getting a big lift for technology. Consumer, with the luxury piece in that, is gaining as well. On the breakdown on the CAC Caron, Hermes up 5.2% right now. L'Oreal following closely behind with gains of 3% in the luxury space. Autos also up, interestingly, by 0.9%. Renault came out with some sales numbers at about 6 a.m. UK time. That stock has actually gained in the last 12 months, up about 40% or so. On the downside, telecoms, media, and utilities, Guy.
We still don't have a price for the CAC. Let's just see what hasn't opened yet. There's a couple of unchanged stocks. It's LVMH and Kering, both yet to get a price. So two heavyweight stocks we've yet to see trade this morning on the CAC Carons, as we see a little bit of price discovery coming through. You are, though, seeing broadly the luxury space having a very good morning. Hermes is already up. It's trading 5.25% to the good. But the two real heavyweights out of that market, no price yet. The market is trying to figure out how to fold the Richemont story into that narrative. Oil stocks continue to gain as well. Total is trading quite nicely. So you're seeing certainly some feed through coming through on the positive side there. There are some downside stocks. It's interesting. We are watching maybe the more defensive end of the market, maybe just soften up a little bit. Stocks like Danone certainly under a little bit of pressure. But we'll wait for LVMH and Kering both to price. LVMH is usually fairly quick out of the gate. Obviously, there's some fairly decent moves that are likely in just a moment when those stocks finally open.
Yeah, really interesting that it was softer as expected in China, but less bad than it had been expected for Richemont. So is the China story starting to turn around? On technology, ASML is getting a big boost. Of course, you cannot operate a TSMC foundry without ASML's lithography machines. That company, of course, listed in the Netherlands, is currently up 3.5%. So despite all the geopolitics and the additional restrictions we've seen put in place, the maker of those lithography machines getting a lift on the back of TSMC's outlook around CapEx, Guy.
Let's talk a little bit about what is happening with the DAX and figure out what is going on there. We do have a DAX that is open, up by around 0.5%. It's interesting, it is that tech story. So you've got names like Infineon doing very well. But defence is also on the front foot this morning, which is interesting as well, given what we see in Gaza. It's less relevant, obviously, to maybe some of the European names, but names like Rheinmetall are up today, up by around 1.4%.
Let's get some more market analysis there and bring in Shanil Ramji, co-head of multi-asset strategy at Pictet Asset Management. Shanil, thanks for joining us. Do you lean into this rally that we're seeing across equities this morning?
Yeah, we think positioning is still quite low. You know, everyone came into the year but nervous about what's going to happen. And we saw that reflected firstly in the bond markets this year with yields rising. Yesterday's data gave a bit of respite, which means investors came in, and that's reflected across the capital structure. So lower cost of capital means better outturn for some equities, especially we see in Europe performing well. So that is helping where especially people have been underweight in Europe. And we think that's a bit of positioning coming through again.
And you want to follow the positioning in Europe in particular. I mean, where would that take you within the European equity space? Is luxury somewhere you want to have more exposure to now, for example?
Yes, I think luxury is an interesting sector in Europe. One, it's a global sector for Europe. It's one where Europe is particularly good at manufacturing those products. Also, it's very in tune with what's happening in China. So if we see some stabilization in China, I think that's going to help also. So what we've seen already with earnings this morning with the luxury names, we think the returns there could be quite substantial given where valuations have dropped so far over the last 12 months.
LVMH is up circa 8% right now.
Well, there you go.
That's a heavyweight stock moving an awful lot on one day. The CAC is now open. It's up by 1.5%. The problem the euro faces at the moment is that it's hard to make an argument to buyers that is different to what we've had before. It's cheap, got a falling currency, but you talk to US investors and they still think that the home buyer story is probably the most relevant one that they need to pursue. You also talk to European investors, a lot of European investors, the first thing on the list is still buy America rather than buy Europe. What reverses all of this?
I think as we get through the new administration coming in, obviously next week in the United States, we'll see what trade policy looks like. And there's a lot baked in terms of investor expectations on tariffs and so on. So understanding a little bit more about what the administration wants to go after and how they build that tariff story will help investors really plan out what they think earnings are going to be in the rest of the world. So in the first half of the year, we think it's much more US sector story, where the administration focused on domestic views of growing America. The second half is going to be us understanding what the rest of the world does in response to that. And there we see the second half story being a rest of the world story where European and even Asian markets can...
So the rest of the world is going to outperform the US this year?
I think in the second half of the year we have much clarity that will help those low valuations in the rest of the world at least get a bid.
Outperform the US? Because that's the argument, isn't it? That's the argument here is, yeah, it's going to improve. Yeah, it's going to get a bid. There's a bid going to be coming. But is the bid going to be bigger than what we see?
If we think about what expectations are for the US today, they're much higher today than they were last year. So the room for positive surprise is much lower, where the room for positive surprise in Europe and
But that's been true for a long time.
True.
So what changes this year to say, I want to put money outside of the US rather than inside the United States? Because all the portfolio managers are sitting there going, if I put money outside the US, I underperform.
Yeah, 100%. So we still think the US is the engine of growth of the world, right? How we think about other economies, for example, the politics, is that able to stabilize in Europe? Given what we see in France and Germany, we don't know yet. Is that a positive surprise coming? We don't know. If it is, I think that can be helpful. In the cessation of the war in Ukraine, that could help sentiment in the European sphere. And finally, whether China finally does the stimulus that is required can also help. So there are things that we want to look at to see whether the rest of the world can start to outperform the US. But the base case is the US is still the engine of growth for the world.
Okay, Richemont, worth noting, up 15% right now. So all that spend from Guy Johnson on Van Cleef jewellery is coming to play. And you're seeing that reflected in the stock this morning. So the luxury boom is significant right now in terms of the upside, a 15% gain for Richemont. What about the currency effects for Europe? To what extent is that going to be a factor that plays positive for Europe on softer dollar? We get to parity, more cuts coming through, that central bank divergence of this year.
Yeah, exactly. So some of those earnings coming through in dollars are going to really help some of those European earnings coming through, that translation effect. So we will look at those global European names that will benefit from that. Equally, we will see some US names that have foreign earnings have to think about that strong dollar being a negative. So again, that is something that we have to think about when we build portfolios that have that cross-currency element to them.
Is dollar peaked at this point?
Well, it'll be interesting to see what the Treasury Secretary nominee says today. There's a lot of points that he's made in the past about what he wants to do with the dollar and how he thinks about funding the U.S. deficit. And I think that's going to mean a lot for investors today to get a bit of clarity around funding the deficit, how he plans to run the U.S. economy, and the fiscal spend that is required.
The 1-year chart, the 5-year chart of Richemont is extraordinary. So we're trading now at a 5-year high, just taking out the previous peaks. The volatility, you could argue today in this stock, is extraordinary. And we're starting to see this emerging in other stocks. We saw Novo Nordisk falling massively the other day, back end of last year. We've seen Eli Lilly doing the same thing on the GLP-1 story and what is happening there. You've got Richemont now rocketing higher. That stock is delivering some extraordinary numbers this morning. Single stock volatility, what should we expect in terms of volatility? Is that going to continue this year in some of these big names? And does that extend into the tech space as well?
I think it will. If we think about returns over the year, I think they're going to be much more narrow than the year previous. But the volatility...
So what do you mean by narrow?
As in, I think the dispersion won't be as wide.
Right.
In terms of what you get from bonds, what you get from credit, what you get from equities. I think the overall return spectrum will be much more narrow this year than was last year. And for that, we think that a diversified portfolio is going to work better because the Sharpe ratios in assets are probably going to be low this year. In that sense, investors will have to bear much more volatility for the returns that they receive. And we already see that this year. We see that in single stocks, and I think that's got to do with expectations. Maybe for those GLP-1 names, the expectations are very high. And any disappointment... NVIDIA expectations are incredibly high. So as we saw after CES, the stock did have a pause, because there were expectations that are very high, and is the company able to achieve that on an ongoing basis? But this is throughout the market. We see bifurcation of expectations, very high in some areas, very low in others.
It's great to see you this morning. Thanks for stopping by to see us. Shanil Ramji, co-head of multi-asset strategy, joining us from Pictet Asset Management. Let's turn our attention to what is happening with the Core 6. This is what the story looks like. Luxury is flying, folks. Take a look at what is happening with LVMH this morning. That heavyweight stock is up by over 8%, but it pales into comparison to the move that we are seeing over in Switzerland with Richemont. Joe.
Luxury, as you say, Guy, absolutely flying this morning. Some sensational moves on these stocks. We've got Richemont up around 16% at the moment. Remember, smashing some of its sales forecasts in terms of the latest period. Some of those numbers in double digits in the last period in terms of their quarterly updates. That stock on track for a record gain if this holds. It is actually the intraday biggest move for around 2 years on that stock. And feeding through into the broader sector, as you say, LVMH, that one was a massive standout, gaining around 8% at the open. There it is now, 8.2%. Now, bear in mind, Bank of America upgrading the stock as well just before the market opened, adding to the excitement, saying that they reckon there is the start of a luxury rebound coming into the market, and LVMH is their big way to play that, being the key powerhouse in that sector, and we're seeing the other firms swatch as well, with the Richemont watch read across, also Kering, Christian Dior. All of these luxury stocks are absolutely having a massive day. We haven't seen a day like that for luxury for some time. Then over in chips, we are seeing some gains in these stocks as well. TSMC, remember, over in Taiwan, gave a big update on their capex spending, around $42 billion they're going to spend on capex, and a lot of their suppliers are rising today. So ASML doing well, up 3.4%, ASMI as well, Soitec, all of those stocks gaining, potentially even a bit of feed through coming through into luxury from other sectors today. Then another stock in clothing retailer, probably more my level. This is Zalando. It's kind of a bit of an ASOS over in Germany, but they've got a big update as well, a sales update, and that spurred an upgrade from UBS, saying that they like this company as a way to play the more lower end of the clothing market. So Zalando, one of the best performers in terms of retail today. A little bit of negativity. We need a bit of red on the screen. It can't all be green. We've got Wise coming down. The UK payment processing company missing on some of its volumes. Now, of course, this was a recent IPO a couple of years ago, and it hasn't had a great run. Down another 3% on that one today. Then in terms of rating changes, the one we flagged earlier, that was a sell at Goldman. That was for Nokia. Now, there is a lot of uncertainty around telecom infrastructure spending, and that's why Goldman cuts Nokia to sell. It's not so much the old phones with the snake game that we all used to play. It is about the infrastructure in terms of telecoms. That's a sell. AB Foods, finally. Primark, again, more in my region than luxury, but AB Foods, Primark. Now, this one, we're down 2%. This one is cut at City due to the rise in employer national insurance is the reason on that one. That's going to push their costs up. Luxury having a great day. AB Foods, Primark, not so much, but a big mover in London today.
Yeah, two different sides of the coin there. Joe Easton from our equities team, fantastic stuff. Thank you very much indeed. These moves keeping Joe and the team busy. Coming up, though, is luxury bouncing back in terms of, well, we can see it bouncing back today. Is that bounce back going to be sustained, though? Is the question longer term, is this a moment that will go down in your diaries as the pivot point for luxury? Richemont posting that surprise double-digit jump in sales. We'll have the details and the read across to the broader sector next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trading. We are 18 minutes into the Thursday session. Continues to be risk on for these equity markets, up 0.6% on the European benchmark. The luxury piece is certainly one of the catalysts. Stocks in focus this morning after Richemont reported a surprising double-digit jump in sales. Its shares, as you can see, soaring more than 15% as things stand. Let's get the details on the earnings front then and bring in from Paris, Bloomberg's luxury and retail reporter, Angelina Rascouet. Angelina, talk us through the results. Investors cheering these numbers.
Absolutely, Tom. Investors are loving it. Richemont is up the most in more than 2 years after it reported sales in the last quarter that jumped more than 10% overall. But what was really impressive was the performance of what they call the jewelry maison. So that's Cartier, Van Cleef & Arpels, and they really that segment really beat estimates. They jumped by 14%. So that really tells you the strong appeal of these brands, the desirability that they have. Despite, uncertain times. And even the watch segment did better than expected. I mean, it was still negative, but it did slightly better than expected. So overall, very strong performance.
Where is the strong performance coming from? Is it the United States? Are we seeing signs of stabilization in China? What's the picture?
Indeed. So the Americas were very strong. Europe as well was super strong, plus 19%. In Europe, generally, it's also led by tourism. In the U.S., what's interesting is that, early November, you had the U.S. elections. And typically what the brands have been telling us in the run-up to the elections is that consumers tend to hold back when it comes to spending ahead of the U.S. elections. But once that's out of the way, then they start to spend. And it coincides as well with a very important quarter, which is the holiday shopping season. China is still a drag. It was down 18%. But overall, Asia-Pacific was down, but not as much as expected. So, very strong set of results geographically.
The moves at the likes of Kering and LVMH suggest that investors are taking a cue and see this as a turnaround more broadly for the luxury space. Is that the right way to read it?
I think Richemont is in a particular category of its own because it really it's in the hard luxury business. So that's very strong jewelry brands that I was mentioning, the timelessness of these goods, and LVMH is more into the soft luxury segment. So they sell you more handbags. If you think about Louis Vuitton, and handbags typically they tend to be more seasonal. There's less that timelessness element about them. So we have to see when LVMH reports at the end of January. Hermes, it's typically one of the strongest brands, and generally they do well even when the market is retrenching. And Kering, we know that it's in turnaround mode. Gucci is really struggling. So again, I think it's you have to distinguish between the strong brands and the weaker brands which are in turnaround.
The move this morning, absolutely extraordinary though. Richemont absolutely flying. Huge move. Take a look at the 5-year chart. Go on your Bloomberg and take a look at the 5-year chart. It's really worth looking at this morning. Angelina, thank you very much indeed. Angelina Rascouet walking us through what we are watching across the European luxury space. It's not just what we're watching with Richemont. It is being replicated elsewhere. LVMH, the heavyweight, rising massively this morning. Should we just talk a little bit about the chip stock? I want to talk about Rio in just a moment. Let's talk a little about chips. The read across from TSMC appears to be quite strong. Is it just the idea that actually the hardware story continues into 2025? Was there a risk that it wasn't going to kind of go into 2025? Because I noticed as well this morning on the TSMC story, they were focusing as well on the fact that CapEx actually doesn't look maybe as strong as some had anticipated. So what's the overall bottom picture?
It's investors consistently, constantly looking for that reassurance that the CapEx spend, that the spend, and that the AI, where we are in this momentum around AI, is not waning. And you have reassurance coming through from executives that is the case, that demand is still there. C.C. Wei, who's the head of TSMC, saying he's more concerned about building out capacity than he is about that demand picture. And on the CapEx, look, the forecasts have been that they'd be spending around $35 billion US. That's now raised to potentially top end 42 billion. They've got the Arizona plant, they say, still on track. That's going to squeeze margins a little, but they just come through with margins of 59%. So you're seeing the read across to the likes of ASML. They supply into these foundries. ASML getting a lift in the Dutch session, up more than 3% right now. The lithography means they're going to have to buy. CC Wei's going to have to put in more purchases. Some of that 42 billion, not all of it, the fraction will go to ASML.
What I find extraordinary here is the gap between the US listed ADRs and what is happening in Taipei. Huge gap in terms of the spread between those two stocks, which maybe just represents the idea that everybody in America is very excited about AI, and elsewhere maybe a little bit more caution creeping in. You kind of want to go to the other end of the supply chain for our next stock story, and that is Rio Tinto. We're talking about copper here, of course, huge part of what we see in the AI story. Rio Tinto, the world's top iron ore exporter, has reported a fall in iron ore shipments amid continued lackluster demand from China. But copper production is up. Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence, joining us around the table. What can I take away? What's the trend here? Is the iron ore story concerning? What do I read into copper? What does this mean for the sector? Kind of give us the top-down picture that we can take away from Rio.
Sure. So I think, look, just to say that the shipments were down, but I think they came within their guidance.
Yep.
So it's nothing to be too concerned about. But certainly all the big diversified miners are trying to grow away from iron ore. That doesn't mean to say that they don't want to protect their iron ore businesses. These are great cash cows for the company. And the assets that many of like Rio has, are very, very cash generative and sit right at the bottom of the cost curve. So they want to protect those, and they are indeed investing in those. But any growth, they really want to skew towards copper. And in Rio's case, they made a sort of good acquisition at the bottom of the cycle in lithium. And they wanting to grow in what they call future-facing metals. So that's copper, lithium for the decarbonisation, electrification story.
Yep.
So that's part of the growth plan going forward. Then is to build out that part of the business. You talk about protecting the iron ore part of the package for them. Where does China? Is China turning around on this? Expectations about stimulus. Is the support coming through?
So in terms of, look, if we take a longer-term view on China's steel demand, I mean, it is arguably in a secular decline. We've probably hit peak steel in China, and demand is probably going to ease lower. The debate in the market is how quickly does that happen? If we look back at Japan and the US, it's similar stages to their industrial cycle. They dropped sort of 20% over a 10-year period. So it could be quite extreme. However, China, I think it was never a smooth path for those two economies, and I think in China it's going to be the same. So actually, for next year and maybe 2026, I think China's, it has certainly indicated that they do want to apply a lot of stimulus. We've got perhaps fiscal stimulus, monetary easing, and I think that is going to be, in a long-term downward trend, give you a bit of a cyclical bump. So I think the outlook for China on steel, and indeed the read across on iron ore, is not quite as bearish as perhaps some in the market are anticipating.
Grant, thank you very much indeed. Grant Sporre, Global Head of Metals and Mining at Bloomberg Intelligence, on the details coming through from Rio Tinto and the ties to China. Coming up, optimism from Renault as its key electric model helps boost sales. Finally, some positive news around the auto sector. We discuss the outlook for European autos next. This is Bloomberg.
missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, is the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
This is the Opening Trade. Welcome back. With 30 minutes into today's session, you are seeing risk on across the equity markets. Gains of 0.5% across the European benchmark. France performing very strongly indeed. The CAC current up 1.4%, lifted by what's happening in the luxury space. But we will focus now on autos, Guy, because you have some numbers coming through from Renault.
We've got the Renault numbers. We've got a broad... There's a little bit of good news coming through from Renault, but it's very hard to find good news when it comes to European auto stocks at the moment. As you can see, we are getting some outperformance there on the back of that. Feels like a very choppy trade this morning in terms of what we're getting. The headlines obviously are coming out of the luxury space, but it's nice to see maybe some good news being delivered for European autos. Horst Schneider, head of European Automotive Research at Bank of America Global Research, joining us in London around the table this morning. Nice to see you.
Good morning.
How tough a year do European auto stocks face this year?
Well,
how much bad news is priced in? Is all the bad news priced in?
It's always the same, like as in the last 2 years. Performance in 24 was terrible. One of the worst performing sectors. Yep. It's cheap now. Beginning of the year, the people think, well, maybe everything is priced in now. Can only get up, and therefore the start to the year, in all fairness, it wasn't too bad, right, in terms of share prices.
So what happens to the rest of the year? Do I want to carry on with this trade?
Again, as in the last 2 years, then probably I think in Q1, Q2, we should be not too bad. And then people feel reminded about the challenges that we face on CO2, on trade. And then towards end of the year, we probably come off again. We have got lots of CMDs coming up this year. So we have got Mercedes, later on Porsche. Nearly every German company is hosting a CMD in H1. And as always, ahead of the CMD...
Capital Markets Day, just for those that don't...
Yeah, exactly, a Capital Markets Day. And as always, ahead of a Capital Markets Day, people believe, well, they tell us something, how it gets better, and therefore the sector lives from hope at the moment.
You think winter is coming to the German auto market? That doesn't fill me with a great deal of confidence.
Hasn't it come already?
Yeah.
I would say winter is there. I would agree to that. Winter is there, right?
So what happens? Do you get mergers? Do you get more factory shutdowns? VW's avoided some of that. They've come to some agreements with union and with Labour. Does Labour have to make more concessions? What gives to get the German auto sector back?
But the key problem for all car makers, not just for the Germans, is there is a killer model is missing. Like Tesla had that with the Model Y. BYD had a few strong models. The Chinese have got strong models. Then you have got the impression there's a long-term future. The problem is at the moment that nearly every EV model has flopped. So what the car makers need is convincing product. And here the hope is a little bit on 2026 when BMW launches a Neue Klasse, Mercedes launches 2 new platforms, which get closer to the techniques that also the Chinese are using. And that's the hope, that the product sells, right? And if the product doesn't sell, then of course you need restructuring. And next to the restructuring, then maybe you need government support. But that's something that the market does not really value, right?
But that's really interesting. You don't think this isn't necessarily an energy story. It's not necessarily a competition with China. Well, that's part of it. But the key thing comes down to actually producing a model that people actually want to buy. This is a design question for these.
Exactly.
So as an investor, do you sit out 2025 then until you get more details in 2026?
Think a little bit like that, because, I mean, you have got some product launches this year because we have tighter CO2 rules. Car makers need to sell more EVs, but it's not yet a convincing product. It's all about software in the vehicle. You need to use servers instead of microcontrollers in the car. You need to centralize the data streams in the vehicle. You need to have autonomous driving features. You get that more with the upcoming generations, and they come as of 2026.
You are close to these companies. Are they capable of delivering that kind of a technology? How fast is the ramp up? What's the rate of change here in terms of what you perceive is going on within these businesses?
I think they can manage it, but the problem is they're at the moment 4 or 5 years behind Tesla and the Chinese.
Does that gap close?
They also don't stand still. They keep running.
Yeah. So how do they close that gap? Do you need to make acquisitions? Is it about hiring software engineers? Is it about buying Rivian technology? How do you close that gap?
You name it. That's what they do. Rivian was from Volkswagen very important, but the problem is that the vehicles from this corporation, they come only in 27, 28, 29. It's a little bit late.
Yep.
BMW is maybe the earliest with the Neue Klasse, so that's 26, early 26. Mercedes is close to BMW, but I think the content that they use is a little bit expensive.
But when was the last time Tesla had a new model?
Well, they have got now the Model Y facelift, but the last new model was basically the Model Y, right?
Yeah.
The Cybertruck. The Cybertruck, I would not really count it as new model because it's not selling in volumes, right? So the last real volume model was the Model Y. They launch now the low-cost car this year. That's why I'm saying H2 could be a little bit more difficult in autos because Tesla launches maybe then the low-cost car, robotaxi in the US. BYD maybe is importing the BYD Seagull. Should be a below 20,000 euro EV in Europe, and that makes, of course, life for European car makers more difficult in Europe.
What is the market share that China takes, ultimately, from BYD, XPeng and others, from European market over a kind of 1 to 2 year period? What are you factoring in terms of the market share that they take?
Well, the problem for the Germans, for example, is in China, the Chinese maybe take everything there. The Germans can just survive on the ICE vehicle. In Europe, it's a different question. Depends also on tariffs, but of course, in the long run, they can take. I mean, long run means within the next 5 years, they may take 5 to 10% market share.
Does the perception of German luxury persist? There's been this kind of, you've got BMW, you've got Mercedes, you've got Porsche. Do these names have the same cachet in the new world that they had before? Because there must have, that was a huge benefit to them. Mm-hmm. And I'm wondering whether, I look at Porsche and I look at you look at a 911, you look at a Taycan. It feels like a very different set of products and a different idea being represented by these kinds of vehicles. Does German luxury, we spent the morning talking about Hermes and LVMH and Richemont, that persists, but does German luxury in the car sector as an ideal, as a kind of truth that existed for generations, does that persist in this new era?
I would say depends on the product. If you look at the combustion engine vehicles, there is the luxury. They have got great 6-cylinder, 8-cylinder vehicles.
They sound amazing.
It's like with a mechanical watch. There's no mechanical Apple. But when we look about EVs, it's digital. Yeah, there's also no digital Rolex. And if you compare, for example, a Xiaomi SU7 to a Porsche Taycan, I don't know, 3-4 times the price, and the Xiaomi SU7 same specs, right? Accelerates fast. Good digital interior, It's probably not the same quality, but of course the price is a lot lower.
But does a market exist? It's nice to have a mechanical watch. Are people going to? There's nobody telling me I can't have one of those on my wrist at the moment, but there are people in Brussels telling me that I can't have a mechanical car going forward. The regulation is very different.
That's a problem. That's why the valuations are low. It's ultimately about DCF, terminal value. How can they compete on these new products? So therefore, it's going to be a difficult journey for them, definitely. And that's reflected in valuation.
Winter is here. Horst, nice to see you.
Thank you.
Guy's animated. Guy Johnson is animated.
I find Porsche just seems emblematic to me of how you make that transition.
Successfully or not?
I think the jury's still out, and it's really interesting to see how. And I think the Rolex comparison is really useful in terms of people drove these cars for what they represented in terms of the mechanical engineering. People have these watches because what they represent in terms of the quality and the craftsmanship. You see it in Richemont this morning, but you're going into a different world. Is the Apple Watch maybe the nearest comparison? I don't know. Of course, great to see you. Thanks very much indeed. Horst Schneider, Head of European Automotive Research at Bank of America Global Research.
Okay. We switch focus to another piece of engineering next, because Jeff Bezos' new flagship rocket, Blue Origin, lifted off for the first time and successfully reached orbit in a crucial test of the firm's ability to challenge another one of Musk's businesses, SpaceX. While the New Glenn rocket's upper stage successfully reached orbit, the booster portion was destroyed as it attempted to land on a barge or drone in the Atlantic Ocean. Let's watch it.
Autopilot enabled. T-minus 10, 9, 8, 7, 6, 5, 4, 1. Lift off.
Okay, that was the launch of New Glenn, a Blue Origin, of course, about an hour and 20 minutes or so ago. Bloomberg Aerospace reporter Kate Duffy joins us for more. How significant was this launch for Jeff Bezos and for the team at Blue Origin?
I think truly significant. This is the first time that they've ever tried out this particular rocket, the New Glenn rocket, and it's been delayed several times because of the vehicle itself and also because of weather conditions, but finally it reached orbit, and that was their key objective during this launch, to reach orbit. They did experience a sort of malfunction failure with the booster, but that's something that can be worked on. This is the first time they're testing out the whole thing, whereas SpaceX tends to test it out in stages. So it's incredible for them, and they're really pleased.
I'm sure they are really pleased, but this thing was meant to be used 25 times. You need to get that bit right. Do we have any indication as to what went wrong, how significant a failure that was? Is it an easy fix? Is it a difficult fix? Do we have any details?
We don't have any details yet. They haven't released anything about what actually went wrong. We know that it just didn't land on this floating barge in the Atlantic at the moment. They're yet to recover the details. They've been collecting all the data, so that the next launch will hopefully see this data being used and proven, and they can sort of resolve what went wrong. So
if they can get it right, how big is the opportunity?
Huge. I mean, this will make sure that they can stand up against the likes of SpaceX and the Falcon 9 rocket. This means that the Blue Origin can take their business into the satellite division as well. They've already got their space tourism business on the go with the New Shepard rocket. And the New Glenn rocket opens up a host of opportunities for them. They have so many contracts. They have about $10 billion worth of contracts at the moment, whether it be with Amazon, Telesat, or AST. They're also on the line for sort of NASA contracts and contracts with the US government as well. So this will open so many doors for them. It is a very lucrative business at the moment, the satellite. There's so many sort of different opportunities to get into. There's so much demand in the market now, so this will really open up the doors for them.
Talk to us about that. So it has more New Glenn has more payload, so it can essentially carry more stuff up into space versus SpaceX's Falcon 9. Does that give them an advantage, and how long can they sustain that advantage if they start commercial operations?
Yeah, it does give them an advantage. But obviously what we're seeing is Falcon 9 is so far ahead of the game. I mean, both companies started working on their rockets at similar times. Falcon 9 is reusable, it's reliable, it's the most frequent rocket that's commercially used.
Is that because they have better engineers? Is it because they are testing and willing to break things? How did you get a 10-year gap? in terms of the innovation for two companies that start at the same time with similar resources?
It's hard to know, but Blue Origin takes more of a traditional approach where it just tests everything in one go, whereas SpaceX it comes across as being more competitive, more sort of, let's just try this out, and if it doesn't work, we're going to go back to the drawing board and just start again. And so what we've seen with them, with their Starship launch, which is hopefully coming up, is that they will test out these sort of dummy satellites that they're going to put into orbit with the Starship rocket, and hopefully they can use the chopsticks again to catch the reusable booster.
That's the technical term, isn't it?
Yes,
chopsticks.
of course, yeah.
It's incredible, though.
Yeah, it is amazing.
See it happen.
Visually amazing,
Yeah, and we didn't see it during the last launch.
No.
So hopefully, you know, the launch that's going to happen in the next day or two, we will see that again.
Great stuff, Kate. Thanks for covering it for us. Bloomberg Aerospace reporter Kate Duffy joining us on what we have seen this morning from Blue Origin and the launch that has taken place there. We'll see another SpaceX launch a little bit later. We'll have some great coverage of that. I just want to break a bit of news that's coming through over the last few minutes. Benjamin Netanyahu's office is indicating that Hamas is creating a last-minute crisis that is halting the Gaza deal. The Israeli cabinet will now not convene to approve the deal until mediators notify Israel that Hamas has accepted all elements of the agreement. So an indication maybe that even phase one is proving difficult to land in terms of what we are seeing in Israel. Hamas, obviously the Qataris have been heavily involved in all of this. The US has been heavily involved in all this, but this is already proving difficult.
We have got so close so many times. We've never been closer than this. Phase one was meant to kick in, to your point, on Sunday. Is this a negotiating tactic to squeeze last-minute concessions out of Hamas by Israel? Is it something more fundamental? Is it a question of the cabinet? Is it a question of getting that support through parliament? We know the extreme right have been opposed to this.
That's not what the Israelis are saying. The Israelis are saying that Hamas is... It is waiting for Hamas to accept all the elements of the agreement. The implication there would seem to be that they're not pushing for anything extra. They just want Hamas to agree to what has been agreed. But as you say, it's not a deal until a deal is signed, and the deal has not been signed and approved, and we've yet to see it coming in. We're expecting this to happen on Sunday, aren't we? So does that deadline now get pushed out until the early part of next week?
Given that all hopes had been that you get this before the inauguration, of course, of incoming President Trump on the 20th. So we continue to monitor this story for you, evolving as we speak. We continue to keep across for you in terms of the details regarding that ceasefire that is looking a little more fragile right now. Coming up, European semiconductor stocks jumping after an upbeat forecast on AI spend from chipmaker TSMC. We dive into the numbers next. This is Bloomberg.
Suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but it's coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too.
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back to the opening trade. We are 48 minutes into the Thursday session. We're seeing further gains across equities. European stocks are up 0.5%. Futures stateside pointing to gains of between 0.4 and 0.6. Over in France, the CAC 40 up 1.5%. Luxury is one of the key drivers on the back of Richemont earnings, but technology as well as a sector also giving Europe a lift. On the tech stocks, you have BE Semiconductor, you have ASM International and ASML, all amongst the leading gainers right now. ASML, the maker of those lithography machines, up 3% so far in the session. That's tied to the earnings and numbers coming out of TSMC, which projected quarterly sales and capex ahead of analyst estimates, up to $42 billion of capex, fueling hopes that the spend on AI hardware will remain strong for this year. Let's get the details of the analysis with Stephen Tung, Senior Tech Analyst for Bloomberg Intelligence. Stephen, what is your making of the results and how they compare to market expectations? Because investors are cheering these results from TSMC. Does it support a stronger outlook for this business?
Yes, I think obviously the company reported a pretty strong set of results for Q4. Pretty much it will come in above expectation in all metrics, revenue margin, earnings, you name it. The demand for the 3 and the 5 nanometer technology has been strong, mainly for the application like high performance computing, which are mostly for AI and also for smartphone. So that's actually a pretty encouraging set of results.
If we take a look at the numbers, as you say, broadly encouraging, are there any areas that investors need to focus on and worry about? This is a company that obviously is right at the center of the AI hardware trade. It is pivotal to so much that goes on in this space. Are there any cracks appearing?
I think on the positive side, apparently the AI demand still ongoing. The management highlighted their confidence on the AI, and it appears that management worries more on the capacity than demand, because they are concerned that the capacity may not be enough to fulfill the demand, which is why they actually has a very strong CapEx guidance, which is, as mentioned earlier, is 38 to 42 billion US dollars versus last year's 29.8. So we're talking about over 30% growth in CapEx, and that's obviously a very strong number. And in terms of demand, the management continue to expect the AI chips to grow. They are looking at more than double growth this year after triple growth last year. And then in terms of the revenue, they also expect the 5-year CAGR to be at least 20%. So all these metrics suggest the company's confidence, and obviously they are very confident on AI and also the ongoing upgrade in their process technology.
Steve, I'm going to leave it there. Stephen Tung, Senior Tech Analyst with Bloomberg Intelligence, joining us on what we're seeing in TSMC. I urge you, there's a great story on the Bloomberg talking about the gap that exists, the multiple gap that exists between the ADRs and what is listed in Taiwan, and just how big that gap is, and maybe just how that represents, you can see it there, how big maybe a gap that represents in terms of the outlook and the euphoria around AI. Let's talk about what we've got coming up for the rest of the day. Bank earnings continue. We'll come back to that story in just a moment. We've got Morgan Stanley earnings. We've got lots of things to talk about in that space, particularly following yesterday. Retail sales are going to be interesting, really interesting. The consumer remains at the heart of this story. How strong could potentially they be? What is happening with the inflationary impulses coming out? Maybe if the consumer will learn more later. Claims are obviously going to be in focus as well. We've got the best sense confirmation hearing coming up too.
Yeah, he's expected to sail through this, given the Republican control of the Senate. He's seen as having quite widespread support. Whether or not he can thread that needle in terms of outlining a policy agenda for the Trump administration from the Treasury in terms of tariffs and tax cuts that are supportive of growth but not inflationary is going to be a question as well.
There's a really interesting Kevin Walsh op-ed in the Journal this morning. I was mentioning it earlier, talking about the idea that actually maybe the incoming administration isn't going to be as inflationary as the market is anticipating. Tariffs, yes, but on the other hand, he sees compensating factors on things like deregulation. Let's talk about what is going on with the banking space in the States. Big day yesterday, huge day yesterday. In some ways, almost eclipsed, though, by the CPI print that we saw coming out. But it's been a bumper earnings season thus far. Profits surging, 4 biggest banks already indicating we've seen some solid numbers. Equity traders at Goldman Sachs, particularly, having a very strong set of numbers. CEO David Solomon, though, calling for changes to the regulatory framework.
We believe it is our responsibility to continue to press for a more transparent regulatory process in order to foster a more efficient financial system that supports growth and competitiveness of the U.S. economy.
Kind of has to say that, doesn't it? Elsewhere, JP Morgan became the first bank in history to report more than $50 billion in annual profit. CEO Jamie Dimon was asked about his plans. The ongoing question, the perennial question, are you going to retire soon, Jamie?
I do love what I do. I'll be 69 in March. I think it's just a rational thing to do. I've had a couple of health problems, I just think it makes a lot of sense.
Let's talk about all of this. Charlie Wells joins us around the table to talk about what we've been going on. Let's start off with the personnel, actually, which is quite interesting. There are quite a lot of things changing, like at JP Morgan and elsewhere. Are we beginning to get the first changes in the guard that we've been anticipating at some of these big banks? Morgan Stanley, we've obviously seen that happen.
Yeah.
But elsewhere?
Yeah, Guy, I would say retirement is kind of in the air. I mean, clearly in the U.S. political sense, Biden is retiring. In the banking sense, there's a lot of questions. There have been promotions. There have been announcements about retirement. Paul Davies, in Bloomberg Opinion, has a really good piece out about this. And in it, he talks about why these financial firms are keeping so mum about it, why they're being so secretive. Jamie Dimon was asked yesterday during that earnings call, point blank, who is your successor? Analysts wanted to know. And he basically said, we'll figure it out. We've got a deep bench. There may be some candidates that you know. There may be some candidates that you don't even know. Why the secrecy? I think the interesting thing here is that these banks, these financial firms, don't want to give investors, they don't want to give the media some kind of false narrative. They don't want to pin, the future on a particular person, have staff internally at the bank start treating them differently, give investors the wrong idea. So that's why there's so much of this kind of secrecy, but also so much of this retirement talk, because that is just in the air.
Given what we saw from the banks yesterday, can we fully expect that the earnings later today out of the big names are going to be as strong, as robust, and the outlook into the rest of this year?
It's looking pretty good. I mean, Bank of America is on tap, and, they're relatively asset sensitive, kind of like JP Morgan. It's been a better story for net interest income for a lot of these banks, so we should see that there. It's going to be really interesting at Bank of America because they have such a huge consumer segment to see kind of how the American consumer is performing. We've also got Morgan Stanley. I mean, they're going to be really interesting in the wealth space because so much of their business has been sort of a pivot into wealth. So, analysts are really looking at kind of flows into wealth management there, but it's looking like a good news story for these banks, and I think that might be why people are so interested in personnel, because expectations are being met. What else can they wonder about?
Yeah, and can the next generation deliver? Charlie, great stuff. Thank you very much indeed, Charlie Wells, on what we're seeing out of US banks. That wraps things up. That was quite a morning. It's been quite a week in terms of what we've seen in terms of the news flow. Today we've had rockets, we've had Richemont, we've had what is going on in Gaza. The news flow is absolutely amazing at the moment, and the volatility in the market is almost in some ways matching that.
Yeah, for now, given those catalysts, if you strip out what's happening in Gaza, it seems to be upside and positivity for these equity markets, at least for now. European and US futures, I should say, pointing higher. The Pulse is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. A fragile reprieve as a deal is reached to pause the 15-month-long war in Gaza, but Israel says Hamas is already reneging on key points. European stocks join a global rally as cooling core inflation in the U.S. keeps alive the prospect of Fed easing this year, and as positive earnings news boosts sentiment. Plus, European luxury stocks soar as Cartier owner Richemont sales unexpectedly jump during the holiday season. So good morning, everyone. There's a lot going on, of course, in geopolitics and politics. We have the stories in the Middle East fully covered. But first of all, let's take a look at the European markets map. Now, we're seeing a little bit of a lift. The CAC 40 gaining 1.4%. We're seeing also gains 0.6% higher for both Milan, but also for the UK FTSE. And that's really on the back of not only some earnings expectations, but a lot of inflation data in the US that's keeping alive the prospect of the Fed easing this year. And again, some of the positive earnings news also just boosted sentiment in general. Cross-asset, a couple of things we need to watch out for. Of course, it's debt. Not only the 10-year in the U.S., but also in the U.K. The U.S. 10-year, 4.6634. We're about 5 days away from the inauguration of Donald Trump. S&P futures getting some 0.3%. And then we look out for data also in Europe later this week. Euro-dollar 102.96, and then Brent 81.86. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, Israel is accusing Hamas of reneging on part of the Gaza ceasefire and hostage release deal that was already agreed upon and is creating a last-minute crisis that prevents the completion of the accord. Now, we've seen people celebrating the deal, but now the Israeli Prime Minister, Benjamin Netanyahu's office, says the government's cabinet will not convene to approve the deal until the mediators notify Israel that Hamas has accepted all elements of the agreement. Well, our Bloomberg colleagues are here to discuss all of this. Anchor Jumana Bersace, Israel Bureau Chief Ethan Broner, and EMEA News Director Ross Matheson. So thank you all for joining us. Jumana, what more do we know about this deal, and how likely is it to lead to a permanent ceasefire?
Well, I think that's the key question here, Francine, and the headlines that have just come out in the last half an hour suggest that there's still a lot of obstacles to move away from a temporary ceasefire towards a permanent cessation of hostilities. Ethan will give some more color from Israel, but the cabinet was supposed to meet later today to vote on the deal, and now some commentary has just put out suggesting that they think that Hamas are reneging on certain elements of the deal, though Hamas themselves just in the last 5 minutes have put out a statement on Telegram saying that they are committed to the terms of the deal. What has been agreed to, though, so far is phase one of a three-phase deal. Phase one, temporary ceasefire with the exchange of 33 Israeli hostages, elderly, children, the sick, some of them thought to have died in captivity in exchange for Palestinian prisoners, and the resumption of humanitarian aid. Of course, there's a huge humanitarian aid need right now in the Gaza Strip. And the third element of phase one would entail Israeli forces gradually retreating away from inside Gaza towards a buffer zone. But to get to phase two, which would entail the release of the rest of the hostages and discussions around a more permanent ceasefire, we would need to see a lot more of these obstacles vis-a-vis what the future governance of Gaza looks like. And some other talking points agreed to on both sides, and those will continue to be sticking points.
Yeah, and Ethan, so the Israeli Prime Minister is basically now saying that Hamas has reneged on part of the ceasefire and hostage release deal, but Hamas just putting out a statement saying that they're committed to the ceasefire deal announced by the mediators. So where are we?
Well, I mean, I don't know where we are, which Germana expressed it well. It looks like there is, I mean, I don't know whether what the Prime Minister is saying is true, but there's no question he's saying it. So at the same time, we're seeing two far-right parties that are part of this coalition threatening to bolt the coalition, which could ultimately bring down the government if this deal goes through. So what looked like a sort of fairly secure deal, and he clearly has a majority of the cabinet and the Knesset to go forward, is suddenly in danger, and that may be affecting his statements about why he thinks about complaints that Hamas is not living up to its side of the deal. I mean, there are numerous details, which prisoners will be released, on what kind of schedule, all sorts of things that are not necessarily all written down, and so it's easy for one side to say suddenly the other side is making new demands. And, you know, fundamentally, they have such different goals. The goal of Israel is for Hamas to be destroyed and eliminated in any position of power in Gaza, and the goal of Hamas is to retain its power and drive Israel out of Gaza. So ultimately, they're on a kind of collision course, even though they're theoretically negotiating a compromise.
And Roz, yesterday, I mean, we also saw a press conference by the Qatar Prime Minister in Doha. I mean, they've been mediating. I imagine today, after this very fragile ceasefire, we're unclear at this moment exactly what happens next. I imagine that both Donald Trump and Joe Biden will be calling the parties involved.
Well, that's right. And of course, it was interesting to see the outgoing U.S. administration and the incoming U.S. administration working together on this. Joe Biden wanting something done before he exits, Donald Trump wanting something as he comes in. And obviously, Benjamin Netanyahu saying he's going to go and see Donald Trump pretty soon. But going forward, this is going to be very messy for Donald Trump. As Ethan was just saying, you've got major complexities inside Israel politically. You've got fundamental differences still between Hamas and Israel. You've got a lot that's not written down already, accusations that one side is reneging on a deal. In what way, we don't know. How much that imperils things is unclear. And a long-running fragility that's going to continue in the region with Israel and beyond, let alone talking about reconstruction. I mean, you've still got issues in Lebanon. You've got what does Iran, intend in all of this, whether they fit in, and their remaining proxies, whether they fit in. And so for Donald Trump, very, very tricky going forward. For Qatar, which is, really pushed hard for many months to get this and been accused by the US at times, not by Joe Biden, by others, of sort of really favouring Hamas. They've been really pushing to get this done. How much do they need to keep Hamas on track? So a lot of fragility, really, and it's not going to be an easy task for anyone.
Ethan, how was the deal received in Israel? And again, have we heard from the far right this morning?
The far right is rejecting the deal. Both parties on the far right have said that they reject the deal. One has said he would remove his party from the coalition if the deal went through. The other has not said that, but is talking about it. And together they have 14 mandates out of 68, which is, you need a majority of 120. So they could, in theory, turn this government into a minority coalition that really couldn't rule. Whether they'll go ahead and do that is far from clear. The understanding until now was that one of these two parties would not walk, but there's incredible pressure. What's interesting is that you see on the far right in Israel, Channel 14, which is a mouthpiece of the far right, as well as Yisrael Hayom, a newspaper of the far right. And then, you know, American conservative Jews are all saying this is bad, this is rewarding terrorism, this is something that will endanger Israel. We mustn't free hundreds of hardened criminals out of Israeli prisons. They will come back and do again what happened on October 7th of 2023. So what looked like a moment in which this compromise could be reached is suddenly imperiled. But it's a little bit hard to tell if it's, you know, just kind of chatter to push certain aspects of the deal forward, or whether it really will not go forward. I don't know.
Yeah, and Jamal, I guess, you know, beyond this, if we do have a ceasefire, then the big, harder question is what the two sides will decide, you know, for the following phase. So if, you know, Hamas wants a full Israeli withdrawal from Gaza and Israel wants to remove Hamas indefinitely.
Yeah, and that is the big question, and speaks to the difficulty of moving from that phase 1 to phase 2, and ultimately to the reconstruction of Gaza, which is phase 3, and talking about future governance and oversight of the enclave as it looks to rebuild. I think it's interesting, Francine, to draw on some of the comments from some of the regional leaders, Arab leaders. The statements put out have been quite cautious, focusing really on the importance of maintaining calm, stability at this point, and the extreme importance of providing humanitarian assistance to the Gaza enclave, where about 9 out of 10 of the population are on the verge of acute food poverty. So the humanitarian needs are great. But for example, the Turkish foreign minister also said that this is the right step towards starting to talk about a potential two-state solution. And that is, of course, something that, that has been put to the wayside over the course of the last 14, 15 months. Saudi Arabia, their voice very important as you think about the future of Arab relations and the potential for that two-state solution. They have said that they welcome the deal, but they also urge the commitment for Israeli aggression in Gaza to end, and for them to complete the withdrawal of Israeli forces from the Strip. So still, a lot of focus is going to be on what happens in the coming months.
Yeah. And Roz, very quickly, if we do get a ceasefire in the next couple of days, and that's, you know, fully complied with, what are the chances then of a permanent truce?
Well, as Ethan and Jemana were saying, very, very difficult. I mean, this is really imperiled all the way along, given, again, the fundamental differences. I mean, Israel says its goal is to eradicate Hamas, and Hamas obviously doesn't want that to happen. And so, you know, you've really got big differences. It was so difficult to get to this point, and even today we're now unsure how much this is going to stick. And so all the way along the line, you've got differences about how many further prisoners in Israel, you know, Palestinian prisoners to release. What does that look like in terms of governance? How long do Israeli troops stay? Where do they stay? I mean, this is exceptionally fragile. And, you know, the idea of fundamentally reconstructing Gaza has to be something that's much more in the future.
Thank you all for joining us. Jemana Barseche, Ethan Broner, and Rosalind Matheson. Now, coming up, traders back at fully pricing in a Fed rate reduction by July following the U.S. inflation report. We'll discuss that next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back, everyone. Now, U.S. consumer prices rose in December by less than expected, making the first step down in 6 months. Now, the data reinvigorates bets that the Fed will cut interest rates actually sooner than previously thought. Well, joining us now to talk about the markets and the year ahead, Natalia Lipikina, head of EMEA Equity Strategy at J.P. Morgan Private Bank, and Rachel Evans, Bloomberg's managing editor for FX rates for the U.S. and EMEA. Thank you both for joining us. I'm also looking at TSM. Now, this is the main chip maker for NVIDIA and Apple, and it's supporting a lot of the future contracts in the U.S. Natalia, it just feels like, tech, and you can see pre-market gaining 5.4%. That's for TSM. Does it just support it? Is it just supported by tech? If tech does well, the market does well.
Thank you, Francine. Very nice to see you. Yes, we think that this earnings season, tech will again be the leader amongst the sectors. Well, actually, if we look into the U.S. market, technology is supposed to rise double digits again this quarter, supported predominantly by this AI theme. And we think that this earnings season, actually, the companies can exceed their expectations again. Last quarter, the earnings growth was 8%. This quarter, the market expects 18%. We actually think that it can be around 14%. Predominantly driven by tech.
And Rachel, I mean, we're, January 16th, and we've had quite a lot of volatility, and everything depends on Fed. I mean, everything always depends on Fed, but I feel like really, even a small percentage point of inflation makes a huge difference to all markets.
Yeah, I mean, it's been an incredibly volatile start to the year, and I think it's just, it tells us how much the market has had to adjust its expectations over recent months. We sort of like August, September time, we were thinking this was going to be a year of, lots and lots of cuts. People have really had to wind that back towards the end of the year. And as we've kind of headed into 2025, it's been this question of, okay, do you stick with the idea that the Fed might just cut once this year? That seems far too low. Even the Fed is saying that they plan to cut twice this year, or at least they see themselves cutting twice this year. So I think the inflation print yesterday, that gave people some sense that, the Fed could afford to cut, that the inflation was coming down and that they would be able to do more this year.
Yeah, but we have so many question marks, Natalia. I mean, we're going into, of course, inauguration on Monday. Inflation could flip depending on tariffs and trade, and that, of course, hurt consumers or not in the U.S., also filtering through equities.
Well, I would say that we had a very strong start to the earnings season, actually, so far. U.S. banks reported yesterday, and we have a confirmation that unemployment rate in the U.S. is low, and the labor market is quite resilient. So on the macro front, actually, we're seeing a lot of support for the equity market. And the CPI print yesterday was also a bit of a relief for the market, and that's why we continue to lean on earnings, thinking that macro is actually quite well behaved right now.
Rachel, is there a belief in the market that actually the scope of damage that the Trump policies could do will be limited because he cares about market reaction?
There is certainly that sort of theory going around, this sense that maybe the introduction of tariffs will be more gradual or more limited because, that we have seen some wobbles in the stock market, particularly as yields have been pushing up around that 5% level. That's got a lot of people worrying about just how much further yields could go and the impact on the stock market. And we know that, Trump has, historically been quite attuned to the stock market. He likes to sort of talk about the stock market rising to records under his watch. And obviously, tariffs would potentially be a headwind for markets generally. So I think there is kind of, it's fair to say that people are thinking, yeah, maybe this would kind of slow down potentially any kind of reaction. But ultimately, we're going to find out pretty soon now. We've got inauguration on Monday. We're promised a bunch of executive orders, pretty soon after. So we'll start to get a more of a sense about how that talk is really going to flow into action.
Yeah, and that could mean volatility for equities and opportunities. How do you build a portfolio around this?
Yeah, so we continue to prefer US over Europe, but we think that investors should have a global approach in order to have the portfolio resilience. This is one of the biggest themes in our outlook this year is be prepared for potential volatility, but at the same time, make sure that you have a global perspective when you build the portfolio.
I mean, talks of volatility, does that happen it happens everywhere. We've seen a bit of volatility in sterling, but is it really dollar that will see most of the brunt?
That is definitely a lot of the prompt for kind of volatility in currency markets this year. Obviously, we've seen kind of, a stronger dollar in recent months on the idea that we will see a sort of an America first type policy, tariffs, etc. And that's really been sort of something that's exaggerated sort of the moves versus other currencies. So as you point out, sterling has been absolutely hammered recently. And a lot of that has been due to kind of UK issues and kind of the global rise in yields. But a lot of it is also due to just kind of this strong dollar situation that I think, every sort of other nation out there is going to have to kind of look at how they feel about their currency versus the dollar.
How do you feel, Natalia, about some of the European stocks? Because again, if the U.S. is priced to perfection, but there's a lot riding on this America First policy, then I guess it's tricky to find other entry points for other stock markets.
Well, we do prefer US over Europe, but we see a lot of interesting opportunities in the market. If you look into luxury stocks that are moving the market today, we've been talking about them for quite some time, and we're seeing that, well, actually, the market was not expecting much, and we're seeing that US consumers are quite strong, and that is definitely helping the sector. Apart from that, industrial sector looks quite interesting. So there are different pockets in the market in Europe.
Thank you both for joining us. Rachel Evans there from our FX team and Natalia Lipikina from JP Morgan Private Bank stays with us. Plenty more to come, and this is Bloomberg.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Well, European luxury stocks are surging this morning after Richemont's surprise third-quarter sales. Now, this partly has to do with some of the low base. Let's get back to Natalia Lipikina, head of EMEA equity strategy at JP Morgan Private Bank. Richemont is getting some 17%, Natalia. I don't know what's going on. So you explained it beautifully. I mean, part of it is that investors are hoping that's an early sign of recovery, but really it's just that it also came from a very low base.
Absolutely. It was a very low base. The market didn't expect much out of this earnings. The last quarter was quite subdued. And we're seeing that actually a lot of regions are showing better than expected performance. US continues to be strong, and that has a bit of an impact on the European performance as well. US tourists coming back to the European region. In China, is not as bad as the market was expecting.
So, I mean, this is a pretty incredible pop, again, from a low base. Are there any other sectors in Europe or elsewhere that could benefit if things go okay for them and China holds on?
I think industrials. Industrials is also the sector that has exposure to China. So if China is not as bad, we may see a positive price reaction because of low expectations, but also industrials because of their exposure to data centers and AI, coming back to what we were discussing before on, AI and tech continue to drive the market further.
How do you view China right now?
Well, we're still waiting to see the fiscal stimulus coming of China. If that happens, that definitely is positive for the European market. But we're now in the wait-to-see mode in the next couple of weeks to understand how tariffs will impact any potential announcement coming out of China.
Natalia, thank you so much. Natalia Lipikina, their head of EMEA equity strategy at JP Morgan Private Bank. Now, coming up, we discuss the ceasefire deal in the Middle East and the broader geopolitical challenges across the globe. We'll be with Cathy Ashton, the EU's first High Representative for Foreign Affairs and Security Policy. That's next, and this is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytical math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power. Live around the world only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. Israel accuses Hamas of reneging on parts of the ceasefire deal to pause the 15-month-long war in Gaza. Hamas says it's committed to the agreement. European stocks join a global rally as cooling core inflation in the U.S. keeps alive the prospect of Fed easing this year, as positive earnings news also boosts sentiment. Plus, European luxury stocks soar after Cartier owner Richemont sales unexpectedly jump during the holiday season. But let's now return to our top story this hour. Israel is accusing Hamas of reneging on part of the Gaza ceasefire and hostage release deal that was already agreed on, creating a last-minute crisis that prevents the completion of the accord. Now, we've seen people celebrating the deal, but now the Israeli Prime Minister, Benjamin Netanyahu's office, says the government's cabinet will not convene to approve the deal until the mediators notify Israel that Hamas has accepted all elements of the agreement. Hamas has responded, saying they remain committed to the deal. Well, my next guest is very familiar with the precarious nature of diplomacy and mediation. Catherine Ashton was the European Union's first High Representative for Foreign Affairs and Security Policy, the first female EU Commissioner for Trade. She's also the author of And Then What? Inside Stories of 21st Century Diplomacy, her insider account of navigating the hallways of power and across the globe. So Cathy Ashton joins us now. Thank you so much. Baroness Ashton, for joining us. I have 1,000,001 question on how to deal with Donald Trump over the next 100 days. But we had news late last night about a ceasefire deal. Many people thought that it would come into effect. And now it's all open on what happens next. What would be going behind the scenes through diplomats now?
So I think there are two things to bear in mind. The first is that this is a really challenging and difficult deal to put together. As we've seen, it's basically the deal that was begun last May, and that Joe Biden has put huge emphasis on with Tony Blinken and the team. And we knew then, and we've known all along, that it would be very, very complicated to put together, not least because the politics are challenging within the region and extremely challenging within Israel. I also think there is something to do with the fact that we're about to change presidents in the US, that the pressure points are kind of a bit odd at the moment. There's a lot of emphasis by especially Benjamin Netanyahu on the role of President-elect Trump. That's understandable. He's putting his own pressure on. His people are working with the Biden team. So it just may be that you need these sort of few days to push forward in order that this becomes maybe the first thing that happens under the new administration. I'm not saying that's the reason why this is held up, but you can see all the sort of political ways that actually trying to get it over the line from the US perspective needs that extra push. And also, of course, for Prime Minister Al-Thani in Qatar.
If, of course, a ceasefire comes into place, what's phase 2 looking like? How do we get to a more permanent truce?
Well, 16 days later, as it were, they have to begin the process of deciding how to make this permanent. There doesn't seem to be, as far as I can read from press reports, a lot of detail about that. And that is a really, really difficult thing to do. You'll have got some hostages out, we hope. They'll have got some aid in, we hope. But there'll be a huge amount to do. And on that 16-day mark depends the future, really, of all the people in Gaza and also for the people of Israel, because trying to move forward with this is of enormous significance to them too.
Of course, Donald Trump is being inaugurated next Monday. What have we learned so far about his foreign policy in regards to the Middle East, but also elsewhere, China, Ukraine?
Well, I think we've had some sort of messages. We know that he's very interested in playing a role in stopping wars, let's put it simply. That, of course, applies to what's happening in Ukraine. But the relationship with Putin is not straightforward, and President Putin does not do what other people tell him to do. So I see a sense that they might be moving away from suggesting that could be done very quickly. And he's obviously going to get a lot of pressure within Congress as well from Ukraine not to just give this away, not to be somebody who's seen to be on Putin's side. And then we've seen some extraordinary statements about Greenland, Canada, and so on. But, you know, he's the master of getting the headline. He's the master of saying something or not saying something in the case of would you use military force against Greenland. You know, the idea that he and Denmark are going to war doesn't seem realistic. But by not saying that, it's set off a whole set of issues, not least for the Danish Prime Minister and for the people of Greenland, but also it kind of keeps things moving along. And it feels like these are almost a little bit of a distraction from the main elements of the foreign policy that he's going to have to put in place, of which China's clearly going to be key, but also what he wants to do on Ukraine and Russia and, of course, in the Middle East too.
You've spent your whole career actually dealing with either unreadable or tricky personalities, foreign, of course, statespeople. What's the right way of dealing with Donald Trump right now?
I spent quite a bit of time with some of his foreign policy people in what we now call Trump 1. And that was really interesting because it's a combination of people who've got years of experience. I may disagree with them on how they do something, but you can see the sense of direction. I think this time we'll see things slightly differently. It will be much more, I think, clear early on where he's trying to get to. And a lot of his work will be domestic. So on foreign policy issues, what I would say to anybody is listen to what he says, because he says what he means at that point, and he often continues to mean it. Look at what the realistic elements of what he's saying are, and that's especially going to be important as everybody gets very nervous about tariffs, but also finding ways that you can build the foreign policy commitments. For example, with NATO. I don't think that he'll pull out of NATO, but I think he is going to pressure for more money to be spent by European countries. And to be fair to him, he's been incredibly successful in achieving what previous presidents have failed to do, which is getting European countries to pay more.
There's the added complexity of Elon Musk, who's an advisor to Donald Trump. We understand he'll have an office in the White House or close to the White House. And he's attacking, including, the Prime Minister, but he's attacking foreign actors. He's supporting some, for example, of the far right in Germany. What's the right way to deal with him?
Well, he's obviously going to be an important player in the Trump administration, at least for now. Whether he will decide to stay long term will partly depend, I think, on where his other interests lie. I always think with anyone who is playing a key role, you have to look at what their motivation might be. And I think for Mr. Musk, he's primarily a businessman. And so some of the things that he's saying are, I think, relevant to how he sees not just his business, but the world he's in, whether it's artificial intelligence, robotics, space, and so on, as being really important. So when he says to NASA, you shouldn't focus on the moon, you should focus on Mars, that's a fair point from his perspective. So some of this is about business. Other, I think, will be about his own opinions.
What's the right way of the UK in dealing with this? Again, they're kind of trying to get the new Labour government trying to get closer to Europe, whilst trying to do to fend off, I guess, the US or some of the attacks from Elon Musk.
We've always had that sort of bridge effect, really, that the relationship with the US is a long-term, ongoing, special relationship that I think the outgoing US ambassador described as the essential relationship. And they'll be very keen to keep that, but to keep it within a framework that actually means we're going to be economically benefiting, politically benefiting. So there'll be a big move too to work with colleagues in NATO on defence security, and I think with Europe. And there's a whole raft of stuff that, from defence and security right the way through to environmental, climate change and so on, where there is a lot of what you might call common cause to be made, that will be different to America's direction of travel, certainly under the president. Whether business chooses a different path is another thing. So it'll be about a balancing act. And I think the only way you can approach it is to stay calm, keep moving, do the stuff behind the scenes, because I'm a huge believer that most of it happens behind the scenes that we never see and shouldn't see. And not get too distressed or kind of turned away from your objectives because of what's happening that seems to be incredibly newsworthy, but actually is just a lot of rhetoric that's going on in the background.
I mean, very true for diplomacy, but also great general life advice. Thank you so much, Baroness Ashton, for joining us. Catherine Ashton, their former EU High Representative for Foreign Affairs and Security Policy. Now, of course, we're top of mind for risk experts surveyed by the World Economic Forum. Up next, we dissect the top global risks of 2025 with the WEF Managing Director, Mirek Dusek. That's next, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back, everyone. We see the last final days of Joe Biden's administration in office going after China. China just announcing that they will launch an anti-dumping probe into U.S. mature chips. So we'll see how that evolves, as, of course, the inauguration of Donald Trump is on Monday. War, top worry, racking the nerves of risk experts surveyed by the World Economic Forum. Now, that's despite incoming U.S. President Donald Trump's vow to end hostilities in Ukraine. Now, the annual survey was released just days ahead of the WEF's annual gathering in Davos. Joining us now, Mirek Dusek, Managing Director of the World Economic Forum. Mirek, thank you so much for joining us. I always look forward to looking at the global risk reports. A lot of it is expected. A lot of it is not expected. You have state-based armed conflict as a top immediate risk for 2025, and then misinformation and disinformation. It feels quite a different report to last year.
Thank you for having me. We're
Very happy to be releasing our 20th Global Risks Report in also preparation for the annual meeting in Davos that's going to be taking place next week. As you said, the top-ranked risk for the current landscape, and we are looking over three categories of time horizons: current, short-term, and long-term. So the current one, indeed, state-based armed conflict is ranked as number 1, and it's a big climber because 2 years ago, for example, in the 2-year outlook, it wasn't even among the top 10 risks. We would assume, of course, based on the data as well as the research that we do accompanying it, that it is, of course, related to the more complex geopolitical environment. We have a record number, unfortunately, of conflicts around the world, humanitarian emergencies, the ongoing war in Ukraine, the conflict in the Middle East would be factors here. On the 2-year time frame, as you also mentioned, the top ranked risk is misinformation and disinformation, which is a return from last year. So that was the top ranked risk for a 2-year time frame. Last year, it's again this year. And we are, I think, all tracking the role of misinformation and disinformation and how it is connected to social polarization.
And Marek, you also have a very interesting, actually, breakdown depending on who you ask in terms of stakeholder groups. So you've asked civil society, international organizations, academia, government, and the private sector. And they also worry about some of the extreme weather events. But it doesn't really come in general as one of the top risks. What's changed?
No, I think just overall, to complete the picture, environmental risks and climate-related risks are consistently ranked highly for the long-term horizon, and that is the case again this year. What is actually new is that, particularly on extreme weather events as well as pollution, it's now popping up more also in the shorter-term horizons as well. So that is actually a change. I guess it's understandable with what is happening around the world right now with extreme weather, particularly for the current landscape. But for example, pollution is something that has, in a way, surprisingly risen in those short-term outlooks based on the data. And so I think this is something that we need to pay attention to.
Yeah, and there's also structural forces that you point to, and this is basically technological acceleration. This is, for example, demographics and geostrategic also shifts. Does that underlay lead to more complexities than 2-3 years ago?
I think overall there is this sense that we are on the cusp of a new era for the world economy, or at least a new situation for the world economy, and so these shifts are being tracked in the data as well. As you said, there is quite some data pointing to increased perception of risks around geoeconomic fragmentation. And on the technology front, that's quite interesting, where in the long-term time horizon, for example, some adverse effects of AI are being tracked quite prominently. But if we look at the short-term horizons, it is not among the top risks. But we've looked at overall how technology-related risks have been faring in the past. This is our 20th edition, and we seem to have this phenomenon where it takes a while for people around the world and experts, business leaders, to really understand the implications of some of these technologies. So usually when these new technologies emerge, there is not as much emphasis on the risk side of things, but then as we take time, we are able to maybe be more nuanced around those considerations as well. Just to say that that's going to be also very much on the agenda next week at the annual meeting in Davos, where we, particularly on the technological front, we will be looking at both, of course, opportunities. It is the theme is shaping the intelligent age, but we also will be looking at risk and ethical use.
Thank you so much, Marek Dusek, their Managing Director of the World Economic Forum. And of course, we'll have full coverage from Davos Week starting from Monday morning. So we have some great exclusive interviews. Please tune in for that as well. Coming up, we talk a little bit more about markets Is luxury bouncing back? Richemont posting a surprise double-digit jump in sales. We'll have the details next. And this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back, everyone. Now, in a moment, we'll talk space with Bloomberg's Kate Duffy. But first, let's talk luxury. Luxury stocks in focus this morning after Richemont reported a surprising double-digit jump in sales. Now, for more on all of this, let's bring in Bloomberg's Charlie Wells. So, Charlie, Richemont, I mean, it's getting some 17%. Was it from a low base, or did they do really well?
They did incredibly well. They really beat expectations. So sales expectations for the final 3 months of the year, those crucial 3 months when holiday shopping really is coming into order, expected to be 1%, but they were actually 10%. Now, Richemont is really interesting. They own Cartier, and that actually gives them a little bit of insulation from the luxury issues that we've seen over the past few years, because people tend to spend on hard luxury, so jewelry, in times of uncertainty. Seems like Richemont is really benefiting here. Let's see how it looks like the stocks in the luxury space are benefiting, but how that continues to play out.
Yeah, and again, U.S. consumer strong, China not too bad, and that's a good combination. What about the banks?
All right, look, so we are in the thick of U.S. big bank reporting. They have been coming out with some really strong narratives. We're seeing on the trading side, records at a lot of the big banks. We're seeing, even on the lending side, money continue to come in from net interest income, given where the rates are. Today on tap, we've got Bank of America. They've got that huge consumer segment that you alluded to. We've also got Morgan Stanley. Analysts looking at Morgan Stanley are really going to focus on wealth management, particularly flows into that business division that has become so important for them.
Yeah, and Charlie, overall, I mean, there's so much talk about succession. I guess that will take a big amount of time on the earnings call.
It's really been generating a lot of buzz. I think it's because, Biden is retiring on the political scene. I think the issue of retirement is just on people's minds. Jamie Dimon yesterday was asked, very specifically from an analyst, who's your successor? He kind of demurred. There have been some promotions, there have been some retirements announced, but really they're kind of staying mum. I think they don't want to give anyone the wrong or the right idea, at least at this point.
Okay, thank you so much, Charlie. Now, Jeff Bezos' is also new flagship rocket, Blue Origin, lifted off for the first time and successfully reached orbit in a crucial test of the firm's ability to challenge SpaceX. Now, while the New Glenn rocket's upper stage successfully reached orbit, the booster portion was destroyed as it attempted to land on a barge in the Atlantic Ocean.
Light this candle.
Autopilot enabled. T-minus 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Lift off.
Now, for more, let's bring in our Bloomberg Eurospace reporter, Kate Duffy. Kate, it always does something, like watching this live, but also rewatching it. They've had to delay it for a number of days. How big a deal is this?
It's a big deal. It's pretty impressive, as you saw from the images there. I mean, the main objective today was to reach orbit and to deliver the test satellites on board, and that's exactly what they did. I mean, they did experience that malfunction with the booster as it landed in the Atlantic Ocean, but moving past that, they can collect the data from that, work on it, and be prepared for the next launch. So it's certainly significant. It means that, Blue Origin can now stand up against SpaceX's workhorse rocket as well.
Yeah, on the same things, or are they? I mean, it's different technologies. So would they actually? I mean, can they ever work together?
I'm not sure about working together, but they certainly do similar things. I mean, they both deliver satellites to orbit. The big difference is that New Glenn it can carry a heavier payload into orbit compared to SpaceX. But obviously, the Falcon 9 is way ahead of New Glenn. It's reusable, it's reliable, it's the most frequent satellite launcher that we have at the moment. But New Glenn, the fact that this actually did succeed today proves that potentially they could stand up against each other and be good competitors.
Kate, how much disappointment was there that, I guess commentators confirmed that the booster portion of the rocket was destroyed as it attempted to land on this barge in the Atlantic Ocean. So first goal achieved, secondary goal set back.
Bit of a setback. This is something that we're seeing with SpaceX's rockets, that they are landing successfully on these barges in the middle of oceans. So this is a really hard bit of technology to master, and it will just take a few more launches, perhaps, for them to sort this out.
Do we know if Jeff Bezos is trying to get close to Donald Trump?
He has commented in a Bloomberg interview that it's a competitive environment, and it's good that SpaceX is also in the business as well. Obviously, Trump's administration is displaying sort of pro-space ambitions. Musk is involved, so it will sort of leverage Bezos's business potentially.
Okay, that's what I'm going to watch at the inauguration. How close the billionaires are sitting next to Donald Trump. Thank you so much, both of you, for joining us, Charlie Wells and Kate Duffy. Now, HSBC is also expected to reduce bonuses for some employees, particularly in corporate institutional banking, as part of its cost reduction efforts. So we'll have plenty more also on some of the European banks shortly. Coming up next, Bloomberg Brief. We'll have plenty more on the markets. We'll have plenty more, of course, on, FX, bonds, and European equities. Luxury, Richemont gaining 17%. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning from our global headquarters in New York. I'm Menace Crenny. You're welcome to Bloomberg Brief. Let's set that agenda. A confidence boost for global risk post-US CPI. Earnings come in strong. That's ahead of the jobless claims and retail sales today. Besson heads to Capitol Hill. Incoming President Trump's Treasury pick braces for a grilling at his confirmation hearing. And bank earnings continue after a strong round of results. Bank of America and Morgan Stanley on deck. Good morning. Ground zero for the repricing of risk was in the bond market yesterday. We're flat at the moment, 466, but wow, what a day. Down 15 basis points on the 10-year government bond yield. Real yield dropped by 11 basis points. And the market now reprices almost one full rate cut in July. Deutsche Bank raised some flags around the headline CPI being at a 10-month high. Were there real buyers in the bonds or short covering? Stocks took it well as yields dropped. Boom, we had the best day for stocks since election day in November. The Mag 7, furious rally, up 3.72%, and the banks up 4.4%. Tech carries through this morning, up 0.3%. Some of the stocks we are keeping an eye on for you. Richemont surging after the sales unexpectedly jumped 10% in the holiday season. TSMC shares rising after its outlook fueled hopes that spending on AI hardware would remain resilient in 2025. And Applied Materials also rising along with other chip makers on the TSMC optimism. Our guests are lining up in just a few moments. I'll catch up with Callum Pickering. He's standing by of Peel Hunt. And later in the hour, we'll hear from JP Morgan's Priya Misra and Optimus CEO Octavio Marenzi on the banks. Let's just reflect on the movement in the bond markets. 4 days that redefined risk. 10-year government bond yields, as I said, dropped by 15 basis points yesterday in the US, and the real yield also repriced. Likewise, in the UK, a massive repricing as their CPI and services inflation rolled over. The market now pricing 50 basis point cut there. What does Callum Pickering make of it all? Callum, good day to you. Risk took a win yesterday. How do you frame this potential peaking in inflation and a return to the disinflation narrative? Good morning.
Good morning. Well, we can see already it's the bond market that's driving risk pretty much across global financial markets. And when I lean back, that makes sense. Thinking about what the world might look like this year, let's try and thread something through everything we see, whether it's in China, whether it's in Europe, Japan, US. Will policymakers get it right? That's the big question. If policymakers get it right, we can see synchronized growth at moderate inflation. If policymakers get it wrong, then there's a lot of risk on the table. So it makes sense that as markets try to understand what might happen next, we see it through the bond market first, and then that reverberates. What makes me nervous is the big moves on fairly small data point changes. Yes, it's good we got upside surprises on US inflation yesterday, but we're really looking at the third decimal place. If we would have been off by 0.5, then suddenly markets are in line, and we don't get the rally in bonds and equities. I find this an uneasy market.
It's certainly fragile, and the 3-month annualized CPI, by the way, is still at an 8-month high on the headline. Deutsche Bank really do dig into this report. The title of your report is Shifts, Shocks and Policy Changes. Today, Scott Bessent is in front of his hearing for his appointment. What is it fiscally that you want to hear as policy evolves from Bessent?
That's a good question. Now, if we just think about the shape of the US economy at the moment, it has really narrow leadership. It's driven by consumer, it's driven by fiscal policy. Trade and industry are weak, parts of real estate are still weak. Now, a good reason why the consumer is strong is because markets are up, people are feeling well off. Part of that is just a conviction by markets that this administration is going to get it right, but they're running a higher wire act. US deficit, it's almost 7%. And so you have this unusual experimental mix of policies in the US, trade tariffs, deregulation, potentially aggressive spending cuts through DOGE. If we see a widening of the US deficit, if this experiment fails, suddenly you see higher yields, you prick the elevated valuations in the equity market, consumers don't feel so well off. So what we need is a conviction that this deficit will remain under control and hopefully heading lower. I think that calms the bond market. I think that calms the equity market. And then I think this consumer and government spending leadership, I think that can remain. But I think it's fragile.
Conviction for the bond market, if the fiscal deficit at the moment is 6% with an extension of the current tax cuts and some, we should be ready for a higher fiscal number. That would say to me the bond market is not done with its exhaustive trade towards the upside.
No, I think that's right. I think the risks in the bond market here are skewed to the upside. It's an unusual mix of policies. Tariffs on their own add to the price level in the US. Tax cuts should stimulate demand, so businesses should have pricing power. On the other side, deregulation and improvement in government efficiency, that should raise tax revenues. It should help control spending. The net effect of these policies will matter. Or, I think to come a little bit one step earlier, the market's expectation of the net effect of these policies will matter. If we were, over the next few months, to see, say, upside surprises in US inflation data, downside surprises in US economic data, before we even have any major policy changes, that could undo the confidence that's underpinning the upward direction that markets seem to be seeking. That's what makes me nervous. I'm really lacking conviction that policymakers will get it right. It's a big if they get it right, and then contingent upon that, yes, we can have a good year. But I think the margin of error here is razor thin for policymakers around the world.
Look, I think 2024 was about data. This year it's about policy, and the risk is this: we front-loaded, according to PGIM. I was listening to Greg Peters yesterday. We've amped up the positives, but we have decried, or we're trying not to think about with cloth ears, what are the announcements on the 20th of January, which don't take Congress, and they are the bigger negatives, and that is the bigger prick to risk, isn't it?
Yeah, I think that's exactly right. And again, if I just take a somewhat lazy view, all the lines are going up in the US. It's great. Just keep running with it. But as risk kind of goes to the moon, everything always feels fine. But then suddenly you see these kind of Wile E. Coyote moments where you realize underpinning the risk actually is not great fundamentals. A few things I'm keeping an eye on. US savings rates for households, they're extremely low. It's okay. We've got employment growth. There's real income growth. households feel well off, they're keen to spend. But even a small return to more normal rates of saving would see demand moderate in the US. The US has had for 2 years growth well above potential, 3% annualized. The Fed thinks sustainable growth in the US is around 1.8, 1.9%. So even going back to what the Fed thinks is sustainable from here would involve a significant moderation in momentum. I think we just need to get through the next, say, 3 to 6 months. Let's answer the policy questions. Let's hopefully see inflation moderate. And what I actually need to see at a global level is risk broaden. We need to see good news out of China. We need to see good news out of Europe. That'll provide some buffer against potential disappointments out of the US.
Very briefly, Callum, in 60 seconds, how ill-prepared are we for a hike from the Bank of Japan next week? The rhetoric is shifting from officials, from Ueda, and from Himanu. How ill-prepared and unpositioned is this market for a hike?
Well, I think we know it's coming. The challenge that we've had is the huge dislocations in the global flow of capital out of places like Japan to the tune of almost $3.5 trillion net, into the US to the tune of 21 trillion net in deficit. We only need small proportional moves in these flows to have big effects on pricing. That's what we saw in August. And so even if we get the announcement for a hike and the next day it's fine, if economic data 2 or 3 days later start to go against that call, then suddenly you're going to get moves. That's what happened in August. That's what we need to get through next week.
Okay, well, we don't know. We really don't want another redux of what happened in August, that tantrum that we had on dollar yen. Callum, thank you very much. Callum Pickering there of Peel Hunt. Let's get to some other stories trending on your Bloomberg terminal this morning. HSBC is set to cut bonuses for some employees in corporate and institutional banking. That's according to Bloomberg sources. This as the cost of restructuring looms under the new CEO, Georges Alhedri, who intends to take the bank in a new direction. Short seller Nate Anderson said he's disbanding his small but renowned firm, Hindenburg Research. He made international waves in January 2023, publishing a report accusing Adani of pulling the largest con in corporate history. The bearish firm cost many companies billions of dollars. Richemont sales unexpectedly jumped by double digits during the holiday season, a tentative sign that the demand for luxury goods may be recovering. Sales soared 10% during the 3 months through December at a constant exchange rate. The news boosted shares, other luxury groups, optimism that the worst may be over for the industry. Coming up, Peace at Risk will bring you the very latest on the truce in Gaza. That's next.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny in New York. President-elect Donald Trump's pick for Treasury Secretary, Scott Bessent, faces his confirmation hearing later today. The hedge fund manager has prepared remarks on the critical nature of the dollar to the U.S. economy. For a closer look on what we can expect, let's get to Ros Matheson. Ros, good to have you with me. Hegseth had a bumpy, tough day on Monday. Rubio glided through yesterday. What's the focus with Bessent going to be? Is it going to be about dollar and tariffs, I presume?
Well, he's got quite a bit of time to talk about his views on everything. And frankly, everything he is asked about is going to be interesting, as you say. We already know that he's going to talk about his desire for the US dollar to remain a strong reserve currency. But is he going to signal how much he wants the dollar potentially to be weaker? We know that Donald Trump has long favored a weaker dollar to help US manufacturers, for example. So, you know, what does that come out as in comments today? Also, how is he going to lay out his plan to be able to extend Donald Trump's tax cuts from 2017 while managing the deficit at the same time? Of course, we've got very big government programs weighing on the balance sheet in terms of Medicare, in terms of Social Security. What is his view about debt issuance, for example, in all of that? You know, does he have a view on the Fed even? Because we know that Donald Trump is not shy in terms of his view on Fed policy and, you know, the personalities at the Fed. Is that something he's willing to wade into? And then, as you say, internationally, what's his view on the very complex and vast patchwork of sanctions that are currently being deployed by the US around the world on companies, on countries, on regimes, and what's his view particularly on tariffs? We know that he's possibly going to push Donald Trump to be slower, gradual in any rollout of blanket tariffs on multiple countries. Is he going to flesh that out in the conversation today? But basically, we know he's going to sail through confirmation. The key thing is what kind of flesh is going to put on the bones of his policy in the conversation today.
Yeah, I think the most interesting is going to be the color around the tariffs. We understand he is the gradualist camp, perhaps, versus Howard Lutnick. Let's talk about Canada. I mean, they are ready robustly to push back with levies on the U.S. if Donald Trump follows through with his tariff plans. Just how big a plan do they have, and do they have unity?
Well, it's very interesting to see. The most striking thing in this, to me, is that they have a very specific plan already. And that's like a lot of countries probably looking ahead and saying, we don't want to just rush and retaliate. We need to have something very specific. We're talking about tariffs potentially on about a third of what Canada imports from the US, and it's a lot. There's no details on specific goods and all of that, but we know that Canada imports a lot of consumer goods, example, you know, from the US, everything from boats to booze. It could all be on the table. What we know where there may not be entire unity from Canada is in the retaliation side. Do they come back by holding back on energy exports to the US? Because, of course, Canada does send energy to the US. It also supplies electricity to the US, particularly in the border areas. Does it wade into those areas? And it seems there's not entire unity amongst the provincial heads in Canada, but certainly a very specific list more broadly being drawn up already.
Okay, well, we'll keep a close eye on that. Ros Matheson, thank you very much, our Bloomberg EMEA Director. Pivoting to the Middle East, a lot of news flow there yesterday on the ceasefire. And the hostage release deal between Israel and Hamas is now being threatened. The Israeli Prime Minister Benjamin Netanyahu's office is claiming that Hamas is creating, in his words, a last-minute crisis, risking the peace agreement. Let's get to our Bloomberg Horizons Middle East anchor, Middle East and Africa anchor, Jumana Bisechi. Jumana, this is the Israeli government saying that Hamas are creating last-minute crisis. What do we know of the demands from the Hamas side, and is it a crisis?
Yeah, well, you raise very pertinent questions, Manus, and I think
you know, it's worth just stating that after many, many false starts over the course of the summer, it did appear yesterday as though the two sides had finally come to an agreement. You had that statement from the Qatari Prime Minister, who, of course, has been working as a key negotiator to bring the two sides together, and the U.S. also lauding the achievement of getting to this ceasefire agreement. Now, it has not been passed yet by the Israeli cabinet. That meeting was supposed to take place today, but just in the last hour, some commentary has come through from the Israeli PM's office suggesting that they believe that Hamas are reneging on certain elements of the deal. Hamas subsequently, a couple of minutes later, the leader put out a telegram saying that they actually intend to stick to what was agreed in the ceasefire arrangement. Now, in terms of what some of those sticking points could be, if you look at phase one of the agreement, which is the humanitarian phase, that entails the exchange of Israeli hostages for Palestinian prisoners. There have been some reservations on the Israeli side as to what prisoners will be released. And there's a precedent to that, of course, with Yahya Sinwar at some point being a prisoner, was released. And then, of course, we know later on he went on to mastermind the October 7 attack. So there is concern from the Israeli side that something like that could be repeated again if the wrong type of prisoner were to be released. Other sticking points are around Israeli forces maintaining a presence within the Gaza Strip. Many within the Israeli government would like to see an only gradual withdrawal until there's complete clarification that Hamas will no longer have a solid grip over the Gaza Strip. And certainly the international community, the U.S., even Arab states, would like to see a future of Gaza where Hamas are not in a position of governance. But at this point, there are lots of questions about what is going to happen to Hamas in the future and whether they will be able to re-equip and to remobilize again. So these are some of the sticking points. And again, a temporary ceasefire, but still a long way away from that permanent solution and cessation to hostilities.
Yeah, a long road to travel on this three-phase deal that's been agreed. Jumana, thank you very much. Jumana Basachi there in Dubai. Coming up on the show, China initiating a probe into the alleged dumping of mature semiconductors by U.S. firms. More on the story in just a moment.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
David Weston,
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Time now for the front pages. This is what's making news on the New York Times, leading with a strong wind, easing in Los Angeles. This as the firefighters make some progress. Forecasters said the current stretch could be almost over, offering a potential reprieve to responders. Crews were also working to keep old fires from reigniting. Washington Post leads with Blue Origin's New Glenn rocket successfully reaching orbit on its first launch. The rocket's lower portion separated from its upper stage, but the booster was destroyed when attempting to land. Now, the Washington Post is owned by Jeff Bezos, who's also the owner of Blue Origin. And Bloomberg leads with this on China. It's set to begin an investigation into potentially illegal dumping of legacy semiconductor U.S. chip makers. Now, that's according to a statement from the Commerce Ministry earlier today. Tom McKenzie standing by as ever on the tech stories. Tom, thanks for being with us on this. It's just dropped in terms of the news flow. The ministry didn't name any particular company, but who should I think of when it comes to legacy or older chips? What names are in the frames? What do we know about the investigation?
Yeah, Manus, look, names that should come to mind would be Qualcomm, would be Micron, would be Intel. Qualcomm gets about 45% of its revenues from mainland China and Hong Kong. Nvidia, by the way, gets about 17% of its revenues. Intel gets about 15%. Micron along similar lines as well. But Qualcomm is, in fact, the most heavily exposed in terms of the Chinese market and the revenue it gets from that jurisdiction. The details around what they describe or what they define as mature or legacy chips is still being worked out. But this is the Ministry of Commerce in China, as you say, in the last half an hour or so, saying that they are going to be launching a probe into anti-dumping of these, quote, mature or legacy chips being imported from the US market. Number one, this could be a tool in terms of potential retaliation versus what is coming down the pike from the incoming Trump administration. It is also, of course, a response to the additional thicket of restrictions that we've had imposed by the Biden administration just in the last week or so. And it's worth noting that China has had some success building out its own mature chip industry. So it's able to supply a lot of those chips into things like the auto-making industry of China that is very chip hungry. It has now built out quite a bit of capacity. Still, China is a major importer of chips as well. So there's two sides to this. They could end up damaging part of their own industry as well, depending on what the results are and how far they go in these restrictions.
I'm going to have everybody IB you and ask you what the word thicket means in the British language. Wonderfully rich phrase. Okay, let's talk about the TikTok saviors, the allies. What is it that we've got? A piece of legislation, an act, it's Democratic lawmakers. They're sort of pushing to extend for TikTok. What do we know?
Yeah, I mean, it just seems like everyone's kind of rushing for the exits, whether it's Democrats or Republicans, to try and rework this bipartisan bill that, of course, could see TikTok banned as soon as Sunday. Trump has come out, he says he wants to save the deal. Shou Chu, the CEO, is going to be at the inauguration. He's going to have pride of place, according to the New York Times. Other reports suggesting that, yes, senators, including Cory Booker, have put in place a bill that would see that ban extended by 270 days so that they can reach some kind of deal. Who, whether Democrat or Republican, wants to be the one labeled as the person who ultimately led to the demise of TikTok, which has 150 million US users? We'll see how this evolves leading up to Sunday.
Tom, thank you very much. Great upsum there, Tom McKenzie, on the very latest potential risks for chip makers here in the United States of America. Coming up, she's in the house. JP Morgan's Priya Misra joins me to discuss everything in the bond market. How do you get the fiscal deficit under control? As Scott Bessent goes to Capitol Hill for his hearing. Questions for Priya Misra. Join me in just a moment.
it'll be easy, but at least there's a theory of change.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Cranny. Let's set your agenda. A confidence boost for global risk post the US CPI. Earnings come in strong. That's ahead of the jobless claims and retail sales today. Besson heads to Capitol Hill. Incoming President Trump's Treasury pick braces for a grilling at his confirmation hearing. And bank earnings continue after a strong round of results. Bank of America and Morgan Stanley on deck. And they deliver the glowing numbers from JP Morgan and the rest of the family. Okay, to the bond market. Ground zero for repricing. Bonds dropped by 15 basis points yesterday, steady this morning, 465. Was that short covering or was that real money buying? It was hard to find a bull in this market, according to HSBC. Real yields dropped by 11 basis points as well, and that had a consequence for risk, that had a consequence for equities. Roll it over, have a look. Stocks, we had our best day since post-election, so post-November the 5th, we absolutely charged higher, up 1.8% on SPOOs. The Mag 7 was up by 3.72%. As rates rolled down and the real yield rolled down, we rolled into a pro-risk narrative. But let me just show you those bond markets for some context, because this is what we're going to start the conversation with Priya Misra on. 10-year government bond yields, as I say, dropped by 15 basis points. The yields dropped by 11 basis points. There was somewhat of an urgency in the market. Priya Misra joins me now, portfolio manager at JP Morgan. There was all this bullish reaction in the bond market. I put it to you that yesterday was more about short covering than it was about real money buying, because you had one piece of data which forced us to reappraise the trajectory for the year.
No, I agree. I think the bond market has been pricing in a couple of things. Been pricing in this idea that maybe the Fed easing was a mistake. That's why the long end had risen. And then the other big one, the elephant in the room really, is in terms of policy. And I think the bond market, and I would argue all markets, are not looking at this as much as a constrained administration. I think the focus has been pro-growth, deregulation, tax cuts, no real spending cuts. And that's why the deficit fears, the bond vigilantes woke up. I think we were in the danger zone. And so what yesterday did was, at least on that first point, did the Fed make a mistake on cutting rates? No. You know, were they worried about the labor market? Yes, but the confidence of inflation, I think some of that confidence came back. Because, you know, the report is what it is, but you look at the guts of the report, owner's equivalent rent, other component service inflations, telling us we're heading slowly but surely closer to that 2%. I think that was a relief. We still have this big question mark in terms of fiscal.
So the rates market repriced the Fed. We brought it forward, but we're still barely one cut in July. Again, have we gone too far to the left tail risk of virtually no cuts?
You know, I think there's a risk that they do not cut at all if inflation does get sticky. Inflation is notoriously hard to forecast. Maybe it does sort of get stuck at 2.5.
Yeah.
In which case, it's going to come down to the labor market. And that's where I will say 6 months ago, I was worried about the labor market. We were seeing signs of slowing down. That seems to have stalled. The economy is solid. What do we get from this administration? Now, if you get tariffs, I think the Fed, we might be talking about Fed cutting. That's not how the market's trading tariffs. But if it does tighten financial conditions, I would argue the dollar and rates, real rates, you brought up real rates, I'm glad you did that. Much of the move has been real rate driven, which is tightening financial conditions. So then we can talk about Fed rate cuts. But right now, I think the Fed is saying, look, we did the easy 100 basis points of cuts. Now we're going to wait and see what do we get from the fiscal side, from the administration. I think they might be on hold for a while.
So this is the next leg of the bond market. If you want to break lower from here, it's going to depend on what Besant promises fiscally over these 4 years. He's on Capitol Hill today. Now, I want you to put the probability, or to try and frame the probability of getting from 6.4% of a deficit to GDP down to 3. How hard is that? How realistic is that?
I think it's very hard. I mean, if you look at where we're spending money, where is that deficit coming from? Interest on debt. There's very little that the government can do on that front. Entitlements, such a big component. Defense, there is no political will to touch most of this. In fact, I would argue the only fiscal hawks typically are in the opposition. But the fact that you have Scott Bessent in there, he's a macro investor, understands markets. I mean, I think a lot of what the administration's talking about, there's a political constraint because there's a very slim Republican majority. There's also a market constraint, and I think Scott Bessent understands that. The fact that he said one of his 3 arrows is getting to 3%, I think that's great, because what that means is when they talk about where do we get fiscal easing, they're also going to say where do we cut spending. Maybe DOGE comes in. I think there's low expectations, but is there places where we can cut some spending? I do think that trying to cut a lot of other taxes is difficult. I think all we're going to spend all year is how do we extend the TCJA, the 2017 tax cuts? That's worth $4 trillion. How much do you get on tariffs? How much do you get in terms of spending cuts? Let's try and at least the trajectory, if it starts to head closer to, I think 3 is a very tall order, maybe over 10 years, if we take some really tough decisions. So you see a lot of caveats in there in terms of ifs. But at least as long as it's not going up, I think the bond market's nervous that this was a campaign promise of 3%, but we're going to just go to 7, 8%, and that's why the vigilantes are waking up.
But you're very clear that the vigilantes are alive. They have not died. They're not a dying breed, and that the market will hold this duo to account, Bessent and Trump. You say they will have a seat at the table.
I think they will, yes. I think with every policy, I think this...
Is there a real inflection point in that bond market for you?
I think we're there. I think above 4.5, particularly in terms of real rates. But when I talk about the 10-year above 4.5, I think people start to pay attention. Every market pays attention. Look at mortgage rates. There's interest-sensitive sectors of the economy that'll get impacted. The dollar, financial conditions. So I think anything above 4.5, the bond market has a seat at the table, and I think this administration with Scott Bessent understands that. So they're going to be very careful about what they say, what they do in terms of the market impact.
Great numbers from JP Morgan. Yes, I was listening to your CFO. There is no question that we are in an animal spirits moment. Of course, your boss, Jamie Dimon, also very, very bullish. But I want to morph this conversation, the bullishness that your bank leaders see in the US economy. I want you to translate that into credit to sovereign risk. In other words, where I am with duration, should I be longer of bonds in the sovereign space relative to credit, or do their comments reinforce long credit on really tight spreads? That's my issue.
So the market is priced for perfection in terms of spreads. So I agree they're tight, but I think they're tight for good reason. You look at corporate America, I would say even the household balance sheets look strong. Companies are not relevering. So those spreads make sense. I think the spreads are there for income. So fixed income has income and has diversification. You talk about sovereign duration, that's where diversification comes in. If you get tightening financial conditions or you get some, I think we're all focused on the positives in terms of the administration. What if you do get, whether it's immigration or tariffs, and you start to see an impact, negative impact on growth, that's where that government duration comes in. So I think high quality spread product, you're getting 6, 7%, makes a lot of sense in a portfolio, particularly when you look at every other asset class and you're priced for very strong growth. I mean, I think where a lot of the optimism, animal spirits comes in is in terms of deregulation. And I'm all for that. Let's reduce the cost of regulation on businesses. But does that translate into more hiring, re-acceleration, more business investment? That's what I'm watching in the earnings season. I think the banks are happy. They've got a lot of potential capital. If Basel III endgame goes away, you have deregulation on banks. That's great. Do they return the money to shareholders or do they go out and give more loans? And they might want to, I think banks would love to make loans. Is the loan demand there? And I think that's what we're watching. If loan demand is there, that starts to feed through into the economy, hiring picks up. Okay, that's great. But what if you just get returned to shareholders and we, remain in this sort of soft landing, which is actually not bad for fixed income. You get 6, 7% with low vol. That's a great environment to be in. Fixed income explains why we're getting the flows.
And just to sort of round off for us here, when it comes to the curve, I mean, there was, as I say, a repricing in real yields. A lot of this shift has been to do with term premium. It's to do with angst over the sort of the fiscal issues. this curve is at some kind of an inflection point for me. Where is it for you?
Yeah, I think there's probably a chance of it continuing to steepen, but I think, again, the easy steepening is done. If the Fed's done cutting that front end or close to being done, maybe there's a couple more cuts, that front end starts to get anchored, then it's all about the long end. You started with Besant. I think I'm going to be watching Besant on this point as well. He has talked about the Treasury's need to extend duration. I would actually argue, as somebody who looks at the Treasury market a lot, there's more demand for 0 to 5 year. So if you hear from Scott Bessent today that the Treasury should be issuing 50-year, 100-year bonds.
But the market politicized what Yellen did in terms of issuance, didn't it?
I would argue what Yellen did was listen to the market, see where the demand is, and respond. And I think that's what Treasury T-back should be thinking about. I still think the demand is in the front end. There's people in the 0 to 5 year sector. I hope that's where Treasury continues to issue. If you hear from Scott Bessent today that they want to issue long end, that steepening will continue. And I would argue that actually tightens financial conditions. Most of us are most of us think about the long end. That's where most companies, 5 to 10 year, that's where households borrow, that's where companies borrow. So that long end is what I think more steepening could be actually a problem for risk assets.
Priya, great to have you with me this morning. That's Priya Misra of JP Morgan. The warnings, you heard them here first in terms of that issuance. Other stories trending on your Bloomberg Terminal this morning. This is what we've got for you. We've just been speaking about him. Scott Bessent proposed to sit down in that hot seat at his confirmation hearing later today. He'll emphasize the importance of maintaining the US dollar as the world's reserve currency in his prepared remarks. The remarks that Bessent's first public comments since Trump nominated him, where he'll play a key role in implementing sweeping economic policy agenda. Prime Minister Netanyahu's office says that Hamas has reneged on parts of the Gaza ceasefire and hostage release deal, and that had already been agreed upon and is creating a last-minute crisis that prevents its completion. Now, the deal aims to pave the way for a permanent end to hostilities, with the talks to follow on the release of remaining hostages. Hamas says it is committed to the accord announced by mediators. HSBC is set to cut the bonuses for some employees in corporate and institutional banking. That's according to Bloomberg sources. That says the cost of restructuring looms under the new CEO, Georges El-Hederi. And he intends to take the bank into a new era. Coming up, we'll talk more about the banks. Ottavio Marenzi of Optimus joins me after yesterday's blockbuster bank earnings. And we look ahead to Morgan Stanley and Bank of America. Context matters every day on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared
prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Brief. A very good morning to you. I'm Manish Cranny in New York. Dollar yen definitely on the march. Yen marching higher against the dollar by over 0.5%. Likewise, the euro repricing. What we have is a very hot hike risk on January the 24th. Bank of Japan officials now acknowledge the likelihood of a hike. This is sort of the third arrow. Ueda has confidence in wages, the highest since 1990. Then his deputy, Himeno, also hinted at the risk of it being a hot meeting. The narrative from the Bank of Japan officials in the past 24 hours is that barring any surprises from Donald Trump, well, everybody should be prepared for some surprises there. They probably will upgrade their projections for inflation. The question is this: how positioned is the market in yen? Jordan Rochester at Mizuho says the positioning is almost non-existent. This market needs to catch up to the idea that a terminal rate of 1% could be on the cards. In terms of the assets in the market this morning, we just finished a conversation with Priya Misra of JP Morgan. She's worried that any bond market over 4.5%. The vigilantes will have a seat at the table. She wants to hear from Scott Bessent in terms of, A, where will you potentially issue on the curve? Should it be at the shorter end of the curve? That is the question. Will it be at the short end of the curve? Listen to the market. That is what she is saying. And in terms of the deficit, that's also critically important for this market. How do you get from 6.4% to 3%? The promise. It's a tall order. A little bit of breaking news for you coming from BP. BP are set to cut thousands of permanent contractors on the job. So this is the very latest breaking headline. Thousands of permanent and contractor jobs are to lose their role with BP.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
It's a multi-trillion-dollar industry. We'll show you.
For you.
Got it.
They're calling the dollar price to perfection.
Oh.
A term that always makes me a little nervous in the financial world.
Yeah, price to perfection. It definitely implies that the dollar is currently trading at a price that reflects only positive expectation for the future.
Right.
Leaving little room for error or unexpected events.
Yeah, and things can happen.
Oh, yeah, they always do.
So let's unpack this a bit.
Okay. Near or nominal effective exchange rate from the Bank for International Settlements.
Okay.
It essentially tracks the value of a currency against a basket of other currencies.
Okay, so a whole bunch of currency.
Yeah, it provides a broader view of its performance on the global stage.
Right.
And according to the NEAR, the US dollar is currently sitting at its highest point in the last 30 years.
30 years? That's a significant stretch.
It is.
But does that necessarily mean it's overvalued?
Well, not necessarily, but it does raise some eyebrows.
Okay.
The IMF's REAR model, the real effective exchange rate, tells a similar story. And Bank of America actually claims the dollar is overvalued by a substantial 18.5%.
18.5%.
Yeah.
Wow.
It's pretty substantial.
So what does that mean for someone listening to this concretely?
Yeah.
Is it like my morning coffee is going to cost more?
Maybe not your coffee.
Okay.
But it could definitely impact other areas of your life.
Right, like what?
Think of it like this. If you're planning a trip to Europe, your dollars won't stretch as far because you'll get fewer euros for every dollar you exchange.
Right.
That Italian leather jacket you've been eyeing,
Yeah.
it might suddenly be out of reach.
Oh, no.
On the other hand, if you're importing goods from overseas,
Yeah.
a strong dollar works in your favor,
Okay.
making those goods cheaper.
Ah, so there are winners and losers depending on where you stand, literally.
Exactly.
Let's rewind for a second and look at what happened in 2024 that led us to this point.
Okay, so 2024 was a stellar year for the US dollar.
It was.
Oh, yeah. It outperformed all other major currencies.
Wow.
Fueled by robust economic growth, some inflationary pressures, and believe it or not, another Trump victory.
Trump won another election.
He did.
That's certainly a surprise.
It was definitely an unexpected turn of events.
Wow.
And his win, along with those other economic factors, propelled the dollar's rally.
I imagine his return to the White House added a whole layer of uncertainty to the global markets.
It did.
But let's stick with the economic factors for now. We can't ignore the Fed's role in all of this, right?
Right.
They're kind of like the puppet masters of interest rates.
Absolutely. The Federal Reserve's interest rate policy has been a major influence on the dollar's strength.
Okay.
They've been slowing down rate cuts, which has pushed U.S. bond yields higher.
Okay.
Think of it this way. When U.S. bond yields are high,
Yeah.
it's like the U.S. government is offering a really good interest rate on a savings account,
Right.
attracting investors from all over the world.
So it's kind of a domino effect. Higher bond yields attract investors.
Yes.
Which increases demand for the U.S. dollar, further strengthening it.
Exactly. It's all interconnected.
Right.
And we're not just talking about domestic investors.
Okay.
International investors looking for a safe haven and attractive returns
Yeah.
are pouring money into U.S. bonds, further driving up the demand for dollars.
So I've got a strong dollar,
Yeah.
high bond yields.
Uh-huh.
But the article also mentions that stock markets are performing well.
They are.
Isn't that a bit counterintuitive?
Yeah, a little bit.
Shouldn't investors be flocking to the safety of bonds instead of the riskier stock market?
You'd think so, right?
Yeah.
Typically, when bond yields rise, it pulls money away from stocks
Right.
as investors seek those safer havens with guaranteed returns.
Yeah.
But what's happening here is a simultaneous surge in demand for both U.S. bonds and U.S. equities.
So are people just feeling super optimistic about the U.S. economy across the board?
It seems that way.
Is everyone drinking the Kool-Aid?
It seems there's a strong sense of confidence in the U.S. market, driving investment in both bonds and stocks.
Okay.
This unique dynamic is adding fuel to the dollar's rally.
Right.
As global investors need those U.S. dollars to purchase both types of assets.
Okay, that makes sense.
Yeah.
But let's bring it back down to earth for a moment.
Okay.
This price to perfection dollar. What does it actually mean for someone in the UK, for example?
That's a great question. And it's particularly relevant because the article specifically mentions the GBP USD exchange rate. The dollar's strength has pushed the pound to its weakest point against the dollar in 9 months.
So not exactly a good time for Brits to be planning a trip to Disneyland, huh?
Unfortunately, no, their pounds won't stretch as far when exchanging them for dollars.
Ouch.
And it's not just travel.
Okay.
Anything imported from the US to the UK is also going to be more expensive.
A double whammy for UK consumers.
Yeah.
But on the flip side, US consumers buying goods from overseas are probably loving life right now, right?
Exactly. Their dollars go further in other countries.
Yeah.
So as I said, there are winners and losers in this currency game.
Okay, so that's where we stand right now.
Yeah.
The dollar is strong, potentially overvalued, with a mixed bag of impacts depending on where you live and what you're buying.
Right.
But what about the future?
Yeah, good question.
Does Bank of America offer any glimpse into the crystal ball?
They do. They predict the dollar will remain strong in the first half of 2025, but could weaken in the latter half of the year.
Oh, really?
Yeah.
What makes them think that?
Well, one factor is the potential for policy changes.
Okay.
Particularly from the Federal Reserve.
Right.
Their stance on interest rates is crucial.
Right.
If they decide to reverse course and start cutting rates again,
Uh-huh.
that could make the U.S. less attractive to investors seeking those higher yields we talked about.
So if the interest rate savings account of U.S. bonds isn't looking so hot anymore, investors might start pulling their money out and weakening the dollar.
Precisely. It all comes down to relative attractiveness.
Okay.
If other countries start offering more competitive interest rates or investment opportunities, the demand for the dollar could decrease.
Right.
For example, imagine a scenario where the European economy experiences a sudden boom,
Okay.
offering attractive investment prospects.
Got it.
That could draw capital away from the U.S., putting downward pressure on the dollar.
So keeping an eye on what's happening in other major economies is important too.
Absolutely.
Not just what's happening within the U.S.
The global economic landscape is constantly shifting,
Mm.
and those shifts can have a significant impact on currency valuations.
Okay, so we've got the Fed potentially shifting course.
Yeah.
And global economic trends to consider.
Right.
And then, of course, there's the wild card we can't ignore, Trump's unpredictable actions.
Right.
The article highlights this as a potential source of market instability.
Yeah, for sure.
How could his, let's call them unconventional geopolitical ambitions, impact the dollar?
It's a fascinating question, isn't it? On the one hand, if Trump were to successfully implement some of his more audacious plans, like annexing Greenland, for example.
Oh, wow.
It could theoretically increase the U.S.'s global power and influence.
Right, a bigger, bolder America flexing its muscles on the world stage.
Exactly.
That could, in theory, strengthen the dollar further.
However, and this is a crucial however,
Okay.
the process of getting there could be incredibly disruptive.
I can imagine.
Imagine the geopolitical fallout,
Right.
the potential trade wars, the sheer uncertainty it would inject into global markets.
Yeah, not exactly a recipe for a stable and predictable market environment.
Exactly. And when investors get nervous,
Yeah.
they tend to seek safer havens.
So while Trump's actions could lead to a stronger dollar in the long run,
Yeah,
if he were to somehow pull off these power plays,
right.
the short-term effects could be quite volatile.
For sure.
We could see a risk premium added to the dollar.
Exactly.
A risk premium?
Yeah.
What exactly does that mean?
A risk premium is essentially an extra return that investors demand to compensate for the added risk of investing in a particular asset.
Okay.
So in this case, if investors perceive the U.S. as becoming a less stable or predictable environment due to Trump's actions,
Right.
they might demand a higher return on their dollar-denominated investments to offset that perceived risk.
Yeah. So it's a bit of a gamble, really.
It is.
Trump's actions could either boost the dollar by solidifying U.S. dominance,
Right.
or send it tumbling due to the uncertainty and risk they generate.
That's a good way to summarize it. It's a high-stakes game with potentially huge consequences for the global economy.
It sounds like we're in a bit of a calm before the storm situation,
Yeah.
as the article suggests.
Uh-huh.
The markets are relatively calm now, but any one of these factors,
Right.
the Fed, global economic shifts, or a Trump curveball,
For sure.
could shake things up dramatically.
That's a very apt analogy.
And how that storm ultimately impacts the dollar is the million-dollar question, isn't it?
It certainly is.
Okay, so we've identified some of the potential risks associated with this price-to-perfection dollar.
Yeah.
A sudden correction triggered by any of these factors
Right.
could send the dollar's value plummeting.
It could.
But what would that actually look like for the average person?
Yeah, good question.
What are the tangible consequences of a dollar correction?
One of the most immediate impacts would be felt in the price of imported goods. A weaker dollar makes those goods more expensive.
Right.
Which can lead to inflation.
So that Italian leather jacket is getting even further out of reach.
It's definitely a possibility.
And
it's not just luxury items.
Oh, okay.
Anything that relies on imported components or raw materials, from electronics to clothing to the food on your table, could see price increases.
That doesn't sound good for consumers.
No, it doesn't.
What about businesses?
Businesses, especially those that rely heavily on exports, would also feel the pinch.
Okay.
A strong dollar makes U.S. goods more expensive for buyers in other countries.
Right.
Making them less competitive.
Yeah.
A sudden drop in the dollar could exacerbate this, hurting their bottom line and potentially leading to job losses.
So a dollar correction could ripple through the entire economy, impacting both consumers and businesses.
Precisely. And the effects wouldn't be limited to the U.S.
Oh, really?
Remember, the U.S. dollar is the world's reserve currency.
Right.
Used for international trade investments and central bank reserves across the globe.
So it's kind of like the anchor of the global financial system.
In a way, yes.
And when that anchor starts to drag, it can create a lot of uncertainty and volatility in global markets.
For sure.
What would that look like in practical terms?
Well, we could see currency fluctuations in other countries as their currencies adjust to a weaker dollar.
Okay.
This could lead to market turmoil and even economic crises in countries that have large dollar-denominated debts.
Right.
As those debts suddenly become much more expensive to service.
So a dollar correction could trigger a global chain reaction.
It could.
It's making me a little nervous just thinking about it.
I understand.
But it's also important to remember that a strong dollar isn't always a good thing either.
That's true.
While it can have benefits like attracting foreign investment and keeping inflation in check, excessive strength can hurt U.S. exporters and make it difficult for U.S. companies to compete globally.
Exactly.
So it's a delicate balancing act. And finding that sweet spot for the dollar where it's strong enough to benefit the U.S. economy, but not so strong that it triggers a global crisis, seems like a pretty tough job.
It is. And as we've discussed, the unpredictable actions of President Trump add another layer of complexity to this already intricate equation.
Okay, so we've covered a lot of ground here. The dollar is strong,
yes,
but potentially overvalued. Multiple factors from the Fed's actions to global economic trends.
Right.
And the ever-present Trump factor.
For sure.
Could send it on a roller coaster ride.
It really could.
What does all this mean for our listeners?
Yeah, that's the big question.
What's the key takeaway?
I think the most important thing is awareness.
Okay.
Understanding the forces at play, the potential risks and rewards of a strong dollar. And the interconnectedness of the global financial system can empower you to make informed decisions.
So stay informed, stay vigilant, and maybe diversify those investments.
That's always a good idea. And perhaps hold off on booking that European vacation until we have a clearer picture of the dollar's trajectory.
Right.
But more importantly, think critically about how these global economic trends could impact your own personal finances.
Okay.
Are you exposed to international markets?
Yeah.
Do your spending habits rely heavily on imported goods?
Right.
These are questions worth pondering.
Excellent advice. Thanks for joining us on this deep dive into the world of currency markets.
It was my pleasure.
We hope you found it insightful and perhaps a little bit unsettling.
It's a complex topic.
It is.
But hopefully we've shed some light on the key dynamics at play.
Right.
And equipped you with some food for thought.
And remember, the world of finance is constantly evolving.
It is.
Staying informed is the best way to navigate its complexities and make smart decisions.
Couldn't agree more.
Thanks for listening, and we'll see you on our next deep dive.
See you then. They predict the dollar will remain strong in the first half of 2025, but could weaken in the latter half of the year.
Oh, really?
Yeah.
What makes them think?
Well, one factor is the potential for policy changes, particularly from the Federal Reserve. Their stance on interest rates is crucial. If they decide to reverse course and start cutting rates again, that could make the U.S. less attractive to investors seeking those higher yields we talked about.
So if the interest rate savings account of U.S. bonds isn't looking so hot anymore, investors might start pulling their money out, weakening the dollar.
Precisely, it all comes down to relative attractiveness. If other countries start offering more competitive interest rates or investment opportunities, the demand for the dollar could decrease. For example, Imagine a scenario where the European economy experiences a sudden boom, offering attractive investment prospects that could draw capital away from the U.S., putting downward pressure on the dollar.
So keeping an eye on what's happening in other major economies is important too, not just what's happening within the U.S.
Absolutely. The global economic landscape is constantly shifting, and those shifts can have a significant impact on currency valuations.
Okay, so we've got the Fed potentially shifting course in global economic trends to consider, and then of course there's the wild card we can't ignore: Trump's unpredictable actions. The article highlights this as a potential source of market instability. How could his, let's call them unconventional geopolitical ambitions, impact the dollar?
It's a fascinating question, isn't it? On the one hand, if Trump were to successfully implement some of his more audacious plans, like annexing Greenland, for example,
Oh, wow.
it could theoretically increase the U.S.'s global power and influence.
Right, a bigger, bolder America flexing its muscles on the world stage. That could, in theory, strengthen the dollar further.
However, and this is a crucial however, the process of getting there could be incredibly disruptive. Imagine the geopolitical fallout, the potential trade wars, the sheer uncertainty it would inject into global markets. Remember, investors generally hate uncertainty. It makes them nervous.
Yeah, not exactly a recipe for a stable and predictable market environment.
Exactly. And when investors get nervous, they tend to seek safer havens. So while Trump's actions could lead to a stronger dollar in the long run, if he were to somehow pull off these power plays, the short-term effects could be quite volatile. We could see a risk premium added to the dollar.
A risk premium? What exactly does that mean?
A risk premium is essentially an extra return that investors demand to compensate for the added risk of investing in a particular asset. So in this case, if investors perceive the U.S. as becoming a less stable or predictable environment due to Trump's actions, they might demand a higher return on their dollar-denominated investments to offset that perceived risk.
So it's a bit of a gamble, really. Trump's actions could either boost the dollar by solidifying U.S. dominance or send it tumbling due to the uncertainty and risk they generate.
That's a good way to summarize it. It's a high-stakes game with potentially huge consequences for the global economy.
It sounds like we're in a bit of a calm before the storm situation, as the article suggests. The markets are relatively calm now, but any one of these factors, the Fed, global economic shifts, or a Trump curveball, could shake things up dramatically.
That's a very apt analogy.
Yeah.
And how that storm ultimately impacts the dollar is the million-dollar question, isn't it?
It certainly is. Okay, so we've identified some of the potential risks associated with this price-to-perfection dollar. A sudden correction triggered by any of these factors could send the dollar's value plummeting. But what would that actually look like for the average person? What are the tangible consequences of a dollar correction? Welcome back to the deep dive.
Yeah.
Before the break, we were talking about the potential risks of a dollar correction, what could trigger it, and the uncertainty surrounding its impact. But let's get down to brass tacks here.
Okay.
What would a sudden drop in the dollar's value actually mean for the average person?
One of the most immediate impacts would be felt in the price of imported goods.
Okay.
A weaker dollar makes those goods more expensive, which can lead to inflation.
So that Italian leather jacket is getting even further out of reach.
It's definitely a possibility, and it's not just luxury items.
Right.
Anything that relies on imported components or raw materials,
Yeah.
from electronics to clothing to the food on your table,
Wow.
could see price increases.
That doesn't sound good for consumers. What about businesses?
Businesses, especially those that rely heavily on exports, would also feel the pinch.
Okay.
A strong dollar makes U.S. goods more expensive for buyers in other countries,
Right.
making them less competitive.
Yeah.
A sudden drop in the dollar could exacerbate this,
Okay.
hurting their bottom line and potentially leading to job losses.
So a dollar correction could ripple through the entire economy,
It could.
impacting both consumers and businesses.
Precisely. And the effects wouldn't be limited to the U.S.
Oh, really? Why is that?
Remember, the U.S. dollar is the world's reserve currency used for international trade investments and central bank reserves across the globe.
So it's kind of like the anchor of the global financial system.
In a way, yes. And when that anchor starts to drag, it can create a lot of uncertainty and volatility in global markets.
What would that look like in practical terms?
Well, we could see currency fluctuations in other countries as their currencies adjust to a weaker dollar. This could lead to market turmoil and even economic crises in countries that have large dollar-denominated debts, as those debts suddenly become much more expensive to service.
So a dollar correction could trigger a global chain reaction?
It could.
It's making me a little nervous just thinking about it.
It's definitely a scenario worth considering, but it's also important to remember that a strong dollar isn't always a good thing either.
Oh, right. Yeah.
While it can have benefits like attracting foreign investment and keeping inflation in check,
Okay.
excessive strength can hurt U.S. exporters and make it difficult for U.S. companies to compete globally.
So it's a delicate balancing act.
It is.
And finding that sweet spot for the dollar where it's strong enough to benefit the U.S. economy, but not so strong that it triggers a global crisis, seems like a pretty tough job.
It is, and as we've discussed, the unpredictable actions of President Trump add another layer of complexity to this already intricate equation.
Okay, so we've covered a lot of ground here. The dollar is strong,
Yeah,
but potentially overvalued.
right.
Multiple factors, from the Fed's actions to global economic trends, and the ever-present Trump factor could send it on a roller coaster ride.
For sure.
What does all this mean for our listeners? What's the key takeaway?
I think the most important thing is awareness.
Okay.
Understanding the forces at play, the potential risks and rewards of a strong dollar, and the interconnectedness of the global financial system can empower you to make informed decisions.
So stay informed, stay vigilant, and maybe diversify those investments.
That's always a good idea, and perhaps hold off on booking that European vacation until we have a clearer picture of the dollar's trajectory.
Right.
But more importantly, think critically about how these global economic trends could impact your own personal finances. Are you exposed to international markets? Do your spending habits rely heavily on imported goods? These are questions worth pondering.
Excellent advice. Thanks for joining us on this deep dive into the world of currency markets. We hope you found it insightful and perhaps a little bit unsettling.
It's definitely a complex topic, but hopefully we've shed some light on the key dynamics at play and equipped you with some food for thought.
And remember, the world of finance is constantly evolving. Staying informed is the best way to navigate its complexities and make smart decisions. Thanks for listening, and we'll see you on our next deep dive.
See you then.
Well under Trump administration. Now, he did slash regulation. He did take a
that the long end of the curve becomes untethered from what the Fed is doing, meaning that it's a big surprise that you've seen this big 100 basis point move in the long end of the curve despite the 100 basis point cuts in the Fed, and we think that that is reflecting some of these fiscal fears. So if the Treasury were to come out and say we want to term out debt, that could increase that untethering that has happened.
Is there not some of that that's happened already? Because there is this expectation that Scott Bessent likes longer term issuance, that he wants to term things out. Is any of that in the price yet?
Well, he said that when yields were lower, and he said that when he didn't have the job. So I do think that when they're looking at this challenge of saying we don't have reverse repo as a tailwind, we possibly won't have the Fed being willing to buy up these bonds through quantitative easing, we think that's actually a big wild card of how would the Fed interact with this. There is this challenge that he doesn't have a lot of wiggle room. So what's stopping bills as a percentage of treasuries going up to 25%?
Bond yields down aggressively yesterday, this morning, up by not even a basis point, a 10-year, 466. Cameron's going to be sticking with us. Cameron Dawson of New Edge Wealth. Up next on the program, we'll be talking about tariffs, and we'll look for Bessent's views on that a little bit later on today. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's bring in Yahara Hackers. Hey, Yahara.
Good morning, John. Israel and Hamas have agreed to a 6-week ceasefire starting this Sunday, a day before Donald Trump's inauguration. Under the terms, Hamas would release 33 hostages taken on October 7th, 2023, while Israel pulls out of populated areas in the Gaza Strip and releases hundreds of Palestinian prisoners. But even before the deal is implemented, Prime Minister Benjamin Netanyahu's office is accusing the Iran-backed group of reneging on parts of the agreement and says Netanyahu's cabinet won't meet until Hamas accepts all points of the deal. Meanwhile, some respite in Los Angeles. The low humidity and dry winds that have fueled the wildfires are forecast to end by midday today, but a lack of rain and another round of winds are forecast for next week. The two largest fires, the Eaton and Palisades, have become among the most destructive in California history, leaving at least 25 people dead and scorching more than 37,000 acres. And Bank of Japan officials think it's likely they'll raise rates at their next meeting. Sources telling Bloomberg it's likely the central bank will hike rates by 25 basis points next week unless Donald Trump ruffles markets or changes expectations about the global economy at the start of his presidency. Quite the caveat. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Dollar yen right now, 155.78. Up next on the program, Scott Bessent heading to Capitol Hill.
I think everyone is on board with a kind of forward guidance or a phased-in tariff. If you bring down your tariffs, we will bring down ours. Everything that I've seen assumes that there is a jump on day one, which will not happen.
Will it happen? That conversation up next. Live from New York City this morning. Good morning.
To the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Three-day winning streak on the S&P 500. Let's see if we can make this day four. Equity futures, so far so good. On the S&P up by 0.28%. Lots to get through the hour. Earnings from Bank of America, then numbers from Morgan Stanley before we get some data for you. Retail sales and jobless claims at 8:30 Eastern Time. Under Savannah's this morning, Scott Besson heading to Capitol Hill.
I think everyone is on board with a kind of forward guidance or a phased-in tariff. President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. If you bring down your tariffs, we will bring down ours. Everything that I've seen assumes that there is a jump on day one, which will not happen.
So here's the latest this morning. President-elect Donald Trump's pick for Treasury, Scott Besson, facing his confirmation hearing on Capitol Hill. Besson writing in prepared remarks, we must secure supply chains that are vulnerable to strategic competitors, and we must carefully deploy sanctions as part of a whole-of-government approach to address our national security requirements. And critically, we must ensure that the US dollar remains the world's reserve currency. Bloomberg's Mike Shepard joins us now for more. From the nation's capital in Washington, D.C., Shep, let's start with trade. What questions do you have that you would like to be aimed at the Treasury Secretary-designate later on today?
Well, he's talked about the tariffs in relation to China there, John, and signaling that there could be a gradual approach. And that is something he said back in August. And it aligns more recently with a great scoop from our colleagues, Saleha Mohsen and Jennifer Leonard earlier this week, saying that a gradual approach could be something that his advisors have on the table. I am curious about what he says about the tariffs that Donald Trump has threatened against U.S. trading partners, Mexico and Canada. We've talked about that a lot on this program and what that could mean for relations between the closest to U.S. neighbors and largest trading partners. Trump has threatened those over border policy issues, not so much economic issues. And we're already seeing Canada just last night preparing a list of countermeasures that it would deploy if Trump unveiled those tariffs. So what would he have to say about that? Cameron also talked about bill management. That would be an interesting question for lawmakers to bring up. It might be a little bit more in the weeds. And then also tax cuts. How does he see that getting through? And will he make the call for cutting corporate rates all the way down to 15%, as we heard Trump put forward during the campaign?
Shep, this is a hedge fund investor, so when he talks about tariffs, he knows the implications for the S&P 500 and what that could be, but he also knows that he has maybe an audience of one, and that's the incoming president, Donald Trump. So how does he walk that fine line?
That's a great question, Anne Marie, because this is what got Scott Bessent the job, in essence. He is the point person for Trump's America First agenda on the economy. And he was able, during the transition and even before that, to demonstrate to both Trump's diehard MAGA allies and to Wall Street that he is the best person for this job, that he actually has Donald Trump's ear and can get the president to maybe move off course if needed. But Donald Trump is somebody who really likes to stay his own course when he sees something he wants. So that will be a tricky task for him. We did see his predecessor under Trump, Steven Mnuchin, last 4 years by successfully navigating all of those pressures from outside the administration and then, of course, from within, especially from the boss.
Well, Shep, we know another big part of this job is engagement abroad. Yellen frequently speaking to counterparts in China and elsewhere. How do we expect the questioning to evolve and answers we might get from Scott Bessent? As we know, Trump has been very vocal, not just about adversaries, but allies as well.
You know, Dana, we did get an early taste of how he views this whole question of economic diplomacy. And he talked in the prepared statement that we referred to at the top of the discussion now, where he sees the importance of maintaining a strong and robust sanctions regime, but one that is perhaps a little more coordinated. And he also is emphasizing that he would want to see the dollar, the greenback, preserved as the world's reserve currency. It's come under some pressure, thanks in part to those sanctions programs, which have called into question for allies and adversaries alike the value of the dollar, given that there are so many political pressures here in Washington and geopolitical pressures generated by those sanctions programs. So this will be another line of questioning we will want to see unfold and learn a little bit about in terms of his ability to carry out economic diplomacy for the incoming Trump team.
Hey, Shep, appreciate your time. Looking forward to this one a little bit later. Bloomberg's Mike Shepard there on the latest as we look for that grilling, that hearing with the Treasury Secretary designate Scott Bessent. One of his biggest positions in the hedge fund a number of months ago, what was it?
Gold.
It was gold. And it was gold. And why? The way they've managed the sanctions issue. This is a guy that's sort of got the levers of government now and can start to think about how to influence things.
He has the levers of government. He also put on two of the most historic trades in the financial community, one of them breaking the Bank of England alongside Stanley Druckenmiller when he worked for George Soros. But he had that gold position because, remember, we talked about this Mohammed El-Arian. He didn't call it de-dollarization. That went too far for Mohammed. But it was this idea of the depreciation of the dollar on the margins because of how many sanctions are just levied against the world right now. What a lot of people will tell me is sanctions don't work. They just create new markets.
Cameron Dawson of New Edge Wealth is still with us. Cameron, let's talk about tariffs. This is what Scott Bessent said to us back in August. Everything I've seen assumes that there is a jump on day one, which will not happen. How much capacity do we have to absorb some bad news next week if it does happen?
Well, as we talked earlier, I think given where valuations are and given where earnings expectations are, there isn't a lot of capacity, meaning that if you were to get a big jump on day one, what would that do to the dollar? We typically have seen a strong dollar in the face of tariffs because it reduces export trade activity. If you see the dollar spike even further, that could be bad for U.S. corporate earnings. We heard from the European luxury guys this morning, and their earnings were great. They're enjoying a strong dollar. They are enjoying a weak currency.
Richemont's flying.
It's absolutely flying. So if we hear from U.S. companies, though, they're likely to talk a lot less nicely about a strong dollar. So if you see a big uplift in tariffs, that would be the risk to U.S. corporate earnings.
Do you expect that to be a theme for this earnings season already as these numbers start to come through?
I think that it is a really good scapegoat for potentially talking down numbers. We've only heard from the banks, which don't have the same kind of currency dynamics. Once we start getting into more of the consumer companies, those that have a lot more exports, the manufacturing companies, it's likely that they use the dollar as an excuse to say, this is why we might have been seeing some softer sales, as a way to talk down guidance. Now, maybe that's an opportunity to jump over a lower bar through the year, but we do think that that will be the scapegoat.
Well, as you say, we're priced to perfection, so we're sensitive. What about Europe, though, that has been lagging behind the U.S., where the bar perhaps for good news is lower?
Valuation is not a catalyst, and sometimes value traps do very much exist, and Europe has been a value trap effectively for the last 14 years. It's been persistently underperforming the U.S., and we think it's less about valuation, it's more about earnings dynamics, and the fact that European indices tend to lead more towards old economy. They don't have the same kind of tech kind of dynamism that has driven U.S. earnings. So until we start seeing an inflection in those kind of old economy earnings that relies on a weaker dollar and likely a commodity cycle, without those two things, really hard to be structurally bullish on that area.
I'd say one thing that surprised me yesterday, though, with the rally everywhere was the DAX hitting a new record. So there are pockets that have been doing well in Europe. Are you looking for any of those pockets, or is it just overall it's a market you don't want to touch?
No, we think selectivity works really well within international markets because it's just much less concentrated. It's really hard to beat the Russell 1000 Growth Index when the top 10 names are nearly 60% of the index. So when you have something like international markets where there's a lot bigger difference between winners and losers, selectivity actually sets you up for better alpha generation or outperformance.
If we can go back to tariffs and winners and losers, last night we have reporting from our colleagues in Canada that they're drawing up a list of what will be the retaliatory measures. The fact that if we have just the tit for tat between the United States, Canada, United States, China, United States, and Europe, how much is that in itself going to dim economic growth?
It's a big risk because we did see that if you look at the data in industrial activity going out of the tariffs in 2018 and 2019, it dipped down. We don't know what it would have done in 2020 because we had COVID that hit, but we did see this industrial recession, or at least a slowdown in the face of tariffs. And there's also this notion that tariffs aren't inflationary, but for those areas that did have tariffs applied back then, prices did go up. It was masked by deflationary moves and things like oil prices back in that time. So we think that there's a lot of potential disruption if you see them applied broadly, given the experience that we had in 18 and 19.
You mentioned Mohammed. Mohammed's talked about this. There are people out there who think maybe we get this one-off price shock. Mohammed's made the point that companies aren't going to wait around this time around. They're going to pass on these price increases pretty quickly.
You could argue that they already are not waiting around. They're already starting to pull forward some of the imports that they're bringing in. Not to mention, even beyond tariffs, a lot of these companies are expecting demand just to all of a sudden be lifted by the animal spirits. The NFIB Small Business Survey showed that they expect sales to pick up pretty dramatically. So across the board, you might be seeing all these companies bringing what they think is going to be the effects of Trump this year forward.
We mentioned Europe briefly. In Paris, France today, on the CAC 40, we are higher by about 2%. Expectations in Europe are rock bottom. So only a little bit needs to go right to engineer big moves. Check out Richemont, up by close to 17% this morning. LVMH is up by close to 10%. Those luxury players are ripping.
I think this is important to note because we talk a lot about the valuation difference between the U.S. and Europe. But if you take the top winners in Europe that are exposed to U.S., that valuation difference shrinks a lot.
Big time. Equity futures this morning up a little bit as well, anticipating more bank earnings. Later this hour, we'll have numbers from Bank of America. A special thanks to Cameron Dawson of New Edge Wealth. Up next, Stephen Cook of CFR on the Gaza ceasefire deal. From New York, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Equity futures on the S&P up again by 0.2%. On the Nasdaq 100 up by close to 0.5 on a 3-day winning streak on the S&P for the first time through 2025 so far. Let's see if we can make it day 4. Yesterday, the biggest one-day gain on the S&P, the Nasdaq, the Russell since November 6th. You remember that day? The post-election day Trump bump. It was that big in yesterday's session, and it was due to this move in the bond market. Double-digit decline on a 10-year yield. Important off the back of a softer than expected CPI print. The 10-year this morning, 465.93. That move, unlocking some dollar weakness. Let's check out the FX market together. Check out dollar yen right now. That's the one to watch. 155.76. We're negative by 0.4%. That's a stronger Japanese yen, and more rumors, more reporting suggesting that the BOJ is about to hike again.
If they get what they need from Donald Trump, and that is no disruption to financial markets. That's what our reporting suggests. It shows just how everything hinges on the U.S., not just the economic data coming in, but also the government. I think it's important to keep in mind that until 8:30 a.m. yesterday morning, the narrative was that the U.S. cutting cycle was over, and that would hamstring all of our international partners. That has changed so rapidly, and again underscores the fact that it could change rapidly again.
Could change again Monday morning. The day after that, when we start to get some executive orders from the incoming president, Donald Trump. Could change this morning. Retail sales and jobless claims at 8:30 Eastern Time, 2 hours away. Under surveillance this morning, TSMC projecting better than expected quarterly sales and capital expenditure, expecting to spend about $40 billion on technology and capacity this year, up to 19% more than analysts had anticipated. That stock is up by 5%, and a lot of other stocks connected to this are up in sympathy.
It just shows how big AI is at the moment. And this is what I come back to. The CEO talked about this idea that smartphone unit growth will be in the low single digit. You think that would be bad. You think that would be bad for their chip sales. But all these phones are incorporating AI into their phones, which means more chips. They also want to be on the leading edge of technology, which means selling more chips. Also, advancements are happening so fast that presumably the turnover cycle is quicker, meaning more chips. So that, plus restrictions on China from the U.S., it is not hurting TSMC.
It's another reason why the mood has lifted in the past 24 hours. I talked a little bit about the data later, 8:30 Eastern Time. One to watch later on this morning as well. This one right here. President-elect Donald Trump's pick for Treasury Secretary Scott Bessent heading to Capitol Hill today. His Senate confirmation hearing kicking off at 10:30 Eastern Time. He's widely expected to win confirmation in the Republican-controlled chamber, but we're all looking for clues on policy initiatives across trade, T-bill issuance, all these kind of things and more.
And also taxes, and this is going to be a big one, especially for Democrats that want to talk about revenue raising and want to stop an extension of TCJA, some of them, not all. He is going to really frame this, according to his opening remarks, that Americans will face the largest tax increase in history if nothing at all is done with TCJA. Also likely, he'll be asked about some of the nuances we've been discussing on this program for months. Will they lower the corporate tax rate? A slew of policies. It's going to be very interesting, I think, between him and Senator Elizabeth Warren. It's going to be a lot of back and forth. a lot of this is performative, but likely this is an individual that is going to get Senate confirmed and sail through.
Must-watch TV, but I think for this bond market, the thing that is of the most consequences is anything he says about debt issuance. Because the other points you raised, they are extremely important, taxes and tariffs, but those could completely change with Donald Trump. Where Scott Bessent has more control and has more influence is whether he terms out the debt. And maybe you're already seeing some of that being built in. Maybe that's why the long end yields have already been rising. But for a bond market participant, I don't know if we're going to get questions or answers about it, but that's going to be what matters for them.
I think we know where they're focused on it, because over the weekend we heard from Vice President-elect J.D. Vance, and J.D. Vance brought it up at an interview a couple of times, totally unprompted, focused on the bond market. I'd also point out this name too, Stephen Mirren, who co-authored that piece with Nouriel Roubini on Treasury activism under the Treasury Secretary Janet Yellen. Stephen Mirren is going to chair the CEA. So that's one to watch as well.
Definitely. They are focused on this. Scott Bessent has been critical of Janet Yellen on this program, and he was just advisor to President-elect Donald Trump months before the election. I was really taken aback at how many times J.D. Vance brought it up in a very general interview when he was so concerned about that the interest payments on our debt is rising so much. 2024 is more than $1 trillion. 2025, it's going to be more than $1 trillion. How do you do that and try to be fiscally responsible?
The 10-year this morning, 466. The 2-year down a few basis points. We're down 2 to 428. Let's get to the latest on geopolitics. Doubts emerging about the Gaza ceasefire agreement. The Israeli Prime Minister Benjamin Netanyahu accusing Hamas of reneging on parts of the deal. Netanyahu's office saying new demands are an effort to extort last-minute concessions. Anne-Marie, you broke this story for us here at Bloomberg in the last 24 hours. What are you hearing now?
Well, what I would say is that there is going to be issues, of course, that arise. This is very difficult when you're dealing with Israel and Hamas, which is designated a terrorist organization. But what I have been told this morning is that they are resolving this snafu, this last-minute issue. But I would not say that all of this is going to be smooth sailing, crystal clear, because of how tenuous and difficult it was to get to this point. What we do know, though, is that the deal is in place, and we should be seeing hostages starting this weekend come out. I have been told about 24 of the 33 that are set to come out are actually alive, and this is just the first phase. When they get later into the agreement, in the second phase, potentially all those hostages could come out.
Jumana Basechi providing leadership out of the region for us from Dubai, and Bloomberg's Jumana joins us now for more. Jumana, what are you hearing? Because there have been some reports that this is close to breaking down already.
Yeah, well, it certainly is a bit of a backtrack versus where we were less than 24 hours ago. But to echo what Anne-Marie was saying, there appears to be an agreement in place. You wouldn't have heard from the Qatari Prime Minister. He wouldn't have given that press conference if he was not sure that all sides were going to agree to it. And you wouldn't also have heard from President Biden or even President-elect Donald Trump. So it appears to be the case of something going on within the Israeli cabinet, because they were due to vote on it at 11 a.m. local time today. They are postponing the decision, claiming that Hamas are reneging on some of the elements of the deal. Now, quickly after that, Hamas put out, the leader of Hamas put out a statement on Telegram saying that they are actually committed to what was discussed with the mediators. So at this point, a bit of flux, but to go back to what our reporting suggests, the phase one of the deal is still very much going to be effective as of Sunday. That would secure the release of those 33 hostages that Anne-Marie was just talking about, some of them thought to have died in captivity, in exchange for Palestinian prisoners. And perhaps that is one of the points of contention that is being raised here, because there are certain factions within the Israeli government that are not so comfortable seeing the release of some of these prisoners. The likes of Yahya Sinwar at one point was held in Israeli prisons. He was released and obviously went on to be the mastermind of October 7. And just one other point that is proving to be somewhat of a sticking point as well, the gradual withdrawal of IDF from the Gaza Strip. Many don't want to see that happen without some certainty about who is going to be governing Gaza once the IDF withdraw.
Unfortunately, nothing's easy about all of this. Jumana, appreciate your time. Jumana Basechi there of Bloomberg out of Dubai. Let's extend the conversation. Stephen Cook of CFR warning the war is not over, writing, it is a complicated deal that will take months to fulfill, if it is ever fulfilled. This gives ample opportunity for the opponents of the deal to undermine it. Stephen joins us now for more. Stephen, welcome to the program, sir. Looking forward to getting your thoughts on this issue. Just first of all, and I think it is significant, who do you think got this over the line? The sitting president or the incoming president?
It's a great question. I think that this is a deal that the outlines of which we are all familiar with going back to last May. But clearly, President-elect Trump, I should say, we have one president at a time, played a role here by sending his own envoy there and talking tough, not just to the Israelis, but also, I believe, the Qataris, in encouraging everybody to get this over the line. Of course, the Israelis have become exhausted in Gaza. Recent reports suggest that Hamas is recruiting at a rate that is even or greater than the number of Hamas militants that the Israelis can kill. And Hamas wants the deal so that it can say that it won. So there was a confluence of interests here, but undoubtedly, President Trump's suggestion that there would be, quote unquote, hell to pay concentrated a number of mines in the Middle East.
Stephen, that's what I've been told by a source in the region, that Trump was able to set red lines, and then Steve Witkoff did some of the heavy lifting. I think a lot of people, though, and I've been talking to everyone about this, would say everyone deserves some credit. And actually, these two teams, whether it's Brett McGurk, Amos Hochstein, Steve Witkoff, Morgan Ortagus, actually worked together. And I've heard a lot of these people actually give the other side some credit. But if Steve Witkoff and Trump was doing the heavy lifting on the end of this deal, likely that is to pressure the Israelis. What does this say about the Trump relationship with Benjamin Netanyahu going forward?
Well, I think the big myth is that Netanyahu and Trump have a really good relationship. In fact, throughout the 4 years of President Trump's first term, neither the president trusted Netanyahu nor did Netanyahu trust the president. They were each expecting the other to double cross each other. And during the elections that occurred, the Israeli elections that occurred during Trump's term, President Trump was rooting for Netanyahu's opponent, Benny Gantz. Netanyahu's tried to make up for this by calling the president-elect repeatedly throughout the transition. We know that President Trump was deeply annoyed with Netanyahu when he congratulated President Biden back in November 2020. So there's a lot of work to do between these two men. And I think that the president-elect was most interested in a deal. So this was not going to be a headache of his on the first day. And that's why he sent Witkoff to put the pressure on Netanyahu.
Biden yesterday, we heard from him, said during the next 6 weeks, Israel will negotiate the necessary arrangements to get phase 2, which is a permanent end of the war. Do you see a permanent end of this war?
No, I don't. And as you were remarking just before, this is a long and complicated process. Only in the 16th day of the first 42-day phase will negotiations begin on the terms of the second phase. Think about how long it's taken us to get to just this outline agreement, these 3 phases. In addition, throughout this long period, there is ample opportunity for opponents to try to undermine it. There's precedent for this in a much larger, longer period. This happened during the Oslo period in the 1990s. There are Israelis who are opposed to it, and people are focused on Bezalel Smotrich and Itamar Ben-Gvir. But there are members of Bibi Netanyahu's Likud party that are opposed to this deal. They've written him a letter and saying, don't put Israel's national security at risk. And of course, Hamas and extremists on the Palestinian side would like nothing more than to continue to suck Israel into a conflict, a never-ending conflict in the Gaza Strip, to further delegitimize Israel in the eyes of the international community. So there's very serious questions about implementation of this ceasefire. And of course, just think in broader terms, after this 15 months of brutal warfare, neither side is looking to bring this conflict to a final peaceful resolution.
Stephen Cook, appreciate your time. Stephen, thank you. Stephen, of course, of CFR. Anne-Marie, fantastic reporting throughout yesterday. By the way, congratulations for that. I think it is significant who helped it get over the line, because we could start to raise questions about how quickly other things could change with the incoming president.
Right, and I think a lot of the adults watching this play out that I speak to say, look, everyone gets credit, right? The deal, the parameters of the deal were put in place by the Biden administration, but Biden was a lame duck after the election, regardless of who won, Kamala Harris or Donald Trump.
Yeah.
So Benjamin Netanyahu was waiting for that. Who am I going to be dealing with? And obviously, it was Trump and his team. Trump immediately sent Steve Witkoff there and really put the pressure on the Israelis to get this over the finish line. So I think there's credit to be given out to both. But in terms of the heavy lifting, I've been told it goes to the Trump team.
Let's see if it holds. Let's see if it holds. If you are just joining us, welcome to the program. Equity futures are positive. Bank of America numbers dropping very shortly. Before we get there, let's get you an update on stories out elsewhere. With your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. Canada has drawn up an initial list of more than $100 billion worth of U.S.-made products that it would hit with tariffs if Donald Trump goes ahead with his threat to impose a levy on Canadian imports. Sources tell us the list is a draft and would come into play only if the Trump administration moves first. Prime Minister Justin Trudeau and the premiers of Canada's provinces met yesterday to plot a strategy for dealing with U.S. protectionism. Meanwhile, the TikTok CEO has joined the list of tech moguls attending Donald Trump's inauguration. The New York Times is reporting Xiao Chu has been invited to sit on the dais where former presidents and other important guests traditionally are seated. The app, owned by China's ByteDance, faces a Sunday deadline to find a U.S. buyer in order to continue operating in the country. Politicians from both parties are seeking ways to keep TikTok accessible in the U.S. despite the impending ban. And shares of Target are rising more than 2% in the pre-market. The company raised its guidance after holiday sales beat expectations. The positive news comes after Target profit guidance late last year following missteps on inventory and product assortment. That's Bloomberg Brief. John?
Hey, Yahara, thank you. Numbers from Bank of America just out for the fourth quarter. Net interest income, better than expected. Upside surprise. Investment banking revenue, better than expected. Upside surprise. The stock up marginally after all these banks rallied yesterday. We're higher by 0.4%. Up next on the program, surging profits for the big banks.
Bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. New administration that's going to be easier on regulations, and as a result of deregulation, the banks are going to benefit from that.
It's hard to disagree with that conversation. Up next.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Equities doing okay. We're up for 3 straight days. S&P futures this morning up another 0.25%. Under surveillance, surging profits for the big banks.
I think the banks are very important. Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well. And they certainly do seem to be doing very well. The economy is growing, loan demand is growing. A new administration that's going to be easier on regulations, and as a result of deregulation, the banks are going to benefit from that. As a matter of fact, I think that the most obvious beneficiaries immediately from the new administration.
The numbers yesterday were good. The numbers this morning, they're good too. Bank of America's up by more than 2%. With those numbers, here's Manus Cranny.
Jonathan, very comfortable beat for Bank of America, not just on the fourth quarter for net interest income coming in at 14.36. So that's a very comfortable beat, but it's about the guidance. For this current quarter in Q1, you're looking at 14.5 to 14.6. You then accelerate through to the fourth quarter of this year. So this is a progressive story on incrementally building on steeper curves on net interest income. By the fourth quarter, you're looking at 15.5 to 15.7. So that's the net interest story. In terms of the bulwark of the bank, fixed income, FICC, we saw pretty good showing yesterday for the others, 2.48 billion, that is a beat. Equities pretty much, I would say, at the money, if not just a bit lighter, 1.64 billion. The street had penciled in 1.69. And we're not in a hurry for provisions either. Provisions for credit losses, 1.45, Jonathan, that's less than expected. So you have 3 legs to the narrative of this stool from Bank of America, which is about steady and growing NII, a very well-functioning investment bank in terms of FIC. And as we've heard yesterday, this sort of low point of where we are in provisioning for a tougher time in the economy. One line from them is that the consumer client spending continue to grow at a moderate pace. Jonathan.
Manus Cranny, thank you. The stock is up by 2.4%. Do they look good, these numbers, from where you're seeing?
They look more than good. Let me tell you something. They never really give this much of a guidance. And you're seeing Bank of America now saying not only are they going to make more net interest income, by the fourth quarter, they're going to be making $1 billion or more in quarterly net interest income by the end of this year. So that is how confident they are. This is due to loan growth. It's better deposit pricing. And it's also, remember, that roll-off of the securities that they held at low interest rates now going into higher interest rates. So this is a Bank of America sweet spot. They're also coming in with a lot of records at their trading desk, which shows they're still competing with the big guys here and keeping a handle on risk. We talked about this yesterday. The equity markets, you're seeing the banks take on a little more risk and maybe leave some dollars on the table because of it, because of the volatility.
I was going to say, usually in this earnings season, we disaggregate the Bank of America's, the more consumer-focused ones versus the Goldman Sachs. Now that we have Bank of America in hand, is there a clear advantage to either business model?
You know, that's the other sweet spot we're looking at. Main Street businesses are doing well, and so are Wall Street businesses. Usually you lean on one or the other, and Bank of America is showing that they're doing both.
Let's head over to Chris Marinak. He joins us from Jenny Montgomery Scott. Chris, we'd love your thoughts on the numbers that just dropped from Bank of America. But for the numbers we saw yesterday as well, how much of this is just about a better environment for the banks? How much of this is about better execution?
John, I think the cost of funds coming down in the fourth quarter is going to repeat itself in the first quarter because we still have the full effect of the 100 basis point Fed cut that's going to filter through. So that's very good for net interest margins again in Q1. That's where the guidance comes in for B of A being positive, not just for now, but also through the year. I think that the comment about Main Street doing well is 100% correct. I also think investment banking still has a lot to go in terms of the inflection point for it to get stronger. It had a very good quarter, as you could see. Asset management continues to be really well. That whole diversified model is playing out quite well. I think the point that we also see is that the overall credit quality continues to be very tame. Charge-offs and problem loans are not having any spike. We're not seeing any follow-through of commercial real estate problems. If anything, the profitability of B of A and all of these big banks is so strong, it allows them to solve their own problems internally. And I think you're seeing that come out in the credit data as well.
Mike Mayo of Wells Fargo, the bank analyst over there, made the comment yesterday that he hasn't heard Jamie Dimon this optimistic in decades. Chris, can you speak to not just the shift in numbers and the improvement there, but the improvement in sentiment among the banking executives?
Well, I think it all goes back to the regulatory shift that we're about to see. I mean, it's going to take 6 to 9 months to have all these new regulatory heads be confirmed and then really begin to do their work. But the outlook is incredibly positive. And we all know the market looks ahead 5 to 6 months. So that's where the bullishness goes. And I think the CEOs are part of that. I think Jamie has been unhappy about the regulatory setup for several years. And now that that starts to unwind, it really allows them to do more business. And this is true for every bank. It's not just the big banks. It filters all the way down to mid-sized, to community banks. It's very healthy for the industry.
But that's the good news of Trump 2.0 for the banks, this idea of deregulation, a tighter regulatory touch. And we've already seen some of that with Barr stepping down at the Fed. But what about things like tariffs, Chris? Is this going to become an issue for the banks?
Sure. I mean, we don't know what we don't know about how companies react to the tariffs. So that is absolutely a risk. I think we have to be vigilant this year about seeing banks continue to sort of keep reserves steady, to watch the C&I books. I think commercial industrial loans are going to be something to watch in terms of how credit unfolds there. It looks like fourth quarter is more of the same. You had very low losses at these big banks through this morning. But I think that that is where the risk could shift quickly, whether it's tariffs, whether it's immigration, or just any other parts of the economy that filter back to banks.
Hey, Chris, at 7:30 Eastern Time, we'll get Morgan Stanley. We'll see if we get the clean sweep. Every bank so far has delivered a beat. Chris, these are big banks, big institutions. Where are the regional players? Do they win too?
I think they do. I think you'll see some regional players out later today with M&T and certainly tomorrow with Truist. First Horizon is out with a good quarter this morning. I think next week after the holiday should be more of the same. I mean, cost of funds is the big factor of production for these companies. And because it's coming down in Q4 and again in Q1, that really does help the margin and the top line revenue for these companies.
Hey, Chris, appreciate your time. Chris Baranek there of Jenny Montgomery Scott. Shanali's still alongside us. Shanali, just give you the final word. Your takeaway from all these numbers and look ahead to Morgan Stanley, please.
You know, you look through the presentations and you look where the loan growth is coming from. This is critical. It means the read-through is not going to be the same across every bank. Page 8 of the presentation for those who are interested, it's commercial loans. It's not really consumer loans. In fact, consumer vehicle lending is up marginally. Home equity is flat. And so is residential mortgages are rising, which is kind of interesting. FICO scores, I love to look at this in the presentation.
What are they now?
For a consumer loan, it's 802. And for a residential mortgage, it's 775. So near perfect. It's telling you that not every consumer could get a loan.
If you're following along at home and you're not in the United States, 802 is like really, 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 really good. Like almost perfect.
I'm not an 802. I'll admit it.
I'm not going to say what I'm at. I lived out of the country for a while, so that impacted things. But it shows, again, it speaks to the good credit quality. And for all those people saying the consumer is falling off a cliff, it hasn't happened. And maybe there is some bifurcation in this, right? To your point, Shanali, that not everybody is getting a loan, but there's still so much strength in these earnings, be it from investment banking or be it from Main Street.
Shanali, appreciate it. We'll see you again in about 35 minutes' time. Morgan Stanley just around the corner. Every bank that's come out with earnings so far in the last 24 hours has beaten estimates. It's been a decent 24 hours. What's not to like? Bank earnings were decent. CPI was softer. Equity futures right now on the S&P 500 just a little bit firmer. Up next on the program, David Leibovitz of JP Morgan Asset Management, Jessica Taylor of the Cook Political Report, and Francis Donald of RBC. From New York, this is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Usually bull markets aren't sustainable unless the financials are doing well, unless the banks are doing well, and they certainly do seem to be doing very well.
What the results speak to is the ability to earn into your valuation.
I think you're going to find that we're going to have robust trading results for all of the big banks.
It's going to be a great year to be an investment bank because I think you are going to get increased volatility in bonds and equities.
I think there's a lot of optimism about policy improving banks.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures up again by 0.25% on the S&P 500. Ed Yardeni said it just then in that little clip. The banks need to do well. The banks are doing well. We've had a beat everywhere across the street. Let's see if Morgan Stanley can complete the clean sweep at 7:30 Eastern Time in 30 minutes. On the Nasdaq 100 up by 0.4%. After we get those numbers from Morgan Stanley, we look ahead to some economic data, retail sales and jobless claims. Then a really important hearing. Scott Bessent, Treasury Secretary Designate on Capitol Hill. That hearing kicks off at 10:30 Eastern Time. We've got to kick it off with Bank of America. These numbers look better than good. Check out this for a stat from the team here at Bloomberg. Investment banking fees jumping 44% in the fourth quarter.
And a lot of those are rates coming down, but also the animal spirits. It's remarkable. I'm going to be really interested to hear from Brian Moynihan and the team at Bank of America just how optimistic they are. The CEOs are optimistic, as are their clients. They've talked about all these corporate clients coming in and giving them loans, and the loan quality looks really solid too. All of these bank results show that some of their credit losses that they're setting aside much lower than what we expected.
And you've heard these conversations on the calls looking out to 2025. It's all about the incoming administration and the policy changes we might see. You might get some clues at 10:30 Eastern Time, and at 3 hours after that, when you hear the grilling that you're going to see down on Capitol Hill with Treasury Secretary Designate Scott Bessent.
Well, when you hear from these Wall Street executives, it's clear there's a vibe shift when it comes to deregulation. We talked about, though, with Chris Marinak just a moment ago, was there's still this uncertainty regarding what is trade regulation going to look like? What potentially is that policy going to end up winning out in the Oval Office? Who's going to win? And we're going to get a little bit more color, potentially, on how Scott Bessent and how he is going to advise the incoming president-elect on how he should be dealing with tariffs and negotiating these trade deals, but he needs to be careful. This is a veteran hedge fund guy who knows that anything he says on trade and tariffs has the potentially move this market.
I think he understands the game. I think we're all looking forward to the hearing a little bit later. Bank of America had a nice rally yesterday, up by 2.9%, following really decent numbers elsewhere. It's up again this morning by 1.6. Coming up this hour, we'll catch up with David Leibovitz of JP Morgan, a stocks gain on the latest earnings news. Jessica Taylor of the Cook Political Report as Treasury pick Scott Besson heads to Capitol Hill, and Francis Donald of RBC as markets reprice rate cut bets. We begin this hour with stocks higher, investors breathing a sigh of relief as bank earnings come in stronger than expected and inflation comes in softer than expected. David Leibovitz of JP Morgan writing this: as inflation gradually moves lower, so too should the federal funds rate. We still expect 2 cuts this year. The biggest risks are a re-acceleration in wage growth or some sort of government policy that reignites inflation. David joins us now for more. David, good morning.
Morning. How are you?
How excited can we get about the last 24 hours?
So I think it was more of a market breathing a sigh of relief as opposed to new information. I mean, what we're seeing is that we're making progress on inflation, but it's the services component that's particularly sticky. And when you break that down even further, where the heat is really coming through is in shelter and then transportation services. It feels like the auto insurance issue is in the process of running its course. Shelter should continue to soften. Where that leaves us is the biggest risk being that if wage growth begins to reaccelerate, that's going to show up in things like food away from home, that's going to show up in services more broadly, and that's really the risk to the Fed adopting a significantly more hawkish tone than they have up until this point.
Yesterday, both stocks and bonds rallied. Do you want to chase either?
So the positive correlation thing is tricky, and we spend a lot of time talking about that because in a perfect world, we'd end the year with stocks higher and rates lower. You know, how much lower can we really go on rates given where the Fed is and given where inflation is? I think that's the big question. You know, we're definitely leaning more into the risk side of the trade as opposed to the duration side of the trade. But I will say with the curve now, you know, positively sloping, you're getting a little bit of carry for being long. Duration doesn't look quite as problematic from a portfolio construction standpoint as it had been when the curve was inverted and you were basically having to pay to be longer out on the curve.
Can I ask, in the curve and the shape that it's doing and getting more steep, there's been a lot of commentary that it's people concerned about fiscal deficits, that it's concerned about the economy. But to some degree, David, this is just normal. This is how things were before the GFC. Is there any element of what we're seeing actually a good thing and a return to some sort of normalization in the yield curve?
So, I mean, fundamentally, having a positively sloped yield curve and having a base rate that isn't zero, I think is very healthy for economies broadly. What I think is particularly interesting about where we are today and the move that we've seen in long rates over the past couple of weeks is really that it is being driven by those concerns around fiscal policy. If you look at the relationship between the 10-year yield and the economic policy uncertainty index, if you look at what's been going on with the term premium, right, all of these are moving higher together. And what that says to me is that the bond market is concerned about something more than the expected path of Fed policy. If we get one cut this year, you know, 465, 475 on the 10-year is pretty much fair value. We would need to see the Fed engage with hikes to get to that 5% number, or we would need to see something on the fiscal front that just causes that concern amongst bond investors.
So some of that is the uncertainty premium. As you watch things like Scott Besson's nomination hearing, as we go through the inauguration and you get different executive actions put in place, what is actually tradable and what just leads to more uncertainty?
So I think it's a question of signal and noise, and I think that the order of operations is going to matter quite a bit here. I mean, my sneaking suspicion is that when President Trump comes into office next week, the first thing he's going to do is unwind a lot of the things that the Biden administration had put into place. So that's step one. Step two is he moves on and begins to pursue his own agenda. We do think he's going to lead with immigration and tariffs, so we may get some of the more punitive stuff first. But on immigration, I think it's going to be a little bit more thoughtful than people are currently expecting. And on trade, I think that this is the beginning of a great negotiation. You know, the news that's come out around tariffs kind of ebbs and flows, and, you know, somebody says one thing and then it gets walked back. I think that tells us a lot about what we should expect in terms of the evolution of trade policy going forward.
So it's used as bluster to get Xi Jinping basically to the table with this maximalist approach, but maybe he actually won't follow through on the maximalist approach. Is that your base case?
Exactly. I mean, if you look at where the United States gets the majority of its consumer electronics from, it's China. We're not going to put a 60% tariff on consumer electronics. Half the reason that Trump's going to be in the White House is because the Biden administration oversaw a period of elevated inflation. And so you have to kind of weigh those forces together and get a sense of, I think he's going to shoot it pretty straight down the middle, but there's going to be a lot of volatility along the way. And that's what we're trying to remind our clients.
That idea keeps coming up in a lot of conversations I have, that inflation is really important for this incoming administration to make sure they're getting down, and that's partially why they won this election. But there is potential that some of what Trump is talking about is inflationary, and you still have 2 cuts priced in for 2025 in the team. How do you weigh both of those?
So I think, first of all, it's important not to put the cart before the horse. And, it was just, 4 or 5 months ago when we were triggering the SOM rule and the economy's going into recession.
A year ago, we had 6, so
markets are still somewhat twitchy. I think the reality is that the broader trend in inflation is lower, and the Fed clearly views the current level of the Fed funds rate as being restrictive. So they remain on a path of more easing. How quickly that easing materializes, to me, is the bigger question. People were talking about March and June and then done. I think we might see first half, second half done, but we're not going to cross that second cut out until we have information that inflation isn't coming down the way that the Fed would like to see. With respect to the interaction with the policies coming out of the White House, tariffs are a one-time level shift. And so we don't really view that, unless it becomes truly tit for tat, as being a source of inflation that the Fed is going to focus on. Immigration could be somewhat inflationary, but I think that takes time to play out. If you look historically, inflation does come in waves. It tends to be a first wave, a pause, and a second wave. To me, if we get that second wave of inflation, and I think it's still a big if, much more of a 2026 story than a 2025 story when you have those tax cuts coming through, when you have more progress on deregulation, and when you have some of these inflationary policies finally working their way through the system and beginning to show up in the data.
Absent a breakdown in the labour market, should the Fed's bias just be to wait? Why would they cut at all, given everything you've just said?
So I think that the reason that they should cut is because, again, if you look at the real Fed funds rate, it is somewhat punitive. Also, when you look at a broad mosaic of labor market data, the 250 payroll gain we got last week doesn't exactly line up with a lot of the other
data. So you're not buying the 250?
I'm not buying the 250. I'm buying the fact that the quits rate has been stable and relatively low. And I think that tells you everything you need to know, because if you're not able to walk out the door of your building, go across the street and get paid 20% more to do the same job, that tells you a lot about the state of the labor market. So look, the labor market's healthy, 4% unemployment, 4% wage growth. This is all really good stuff, but I do think on the fringes, you're seeing that softening, and that is what is causing the Fed a bit of concern in this environment.
If you had to take a bet, if you were thinking about how this labor market might break, a re-acceleration or a real deceleration, are you betting on the latter and not the former?
I do think that the risk is still to the upside. This is a very healthy economy. Real income growth remains positive. We have the prospect, if we get this deregulation, if you get, more favorable tax treatment, you could see CapEx begin to tick higher, and that's one of the more cyclical parts of the economy. And so, the engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that's probably a risk that we can't dismiss.
I find it really notable that the thing that continues to be consistent is that quits are lower, it's getting harder to find new work, and you're seeing wage growth stagnant. If you don't trust the headline data, should we just continue to look at that? Does that need to be our guiding star in this economy?
So that's why I was so surprised on Friday, and everybody was freaking out, 250,000 jobs. I'm like, guys, wage growth is coming down. I mean, isn't that what really matters when it comes to inflation? It's not the number of jobs you're creating, it's the amount of money that's going into people's pockets. And furthermore, the data from the Atlanta Fed yesterday that breaks down wage growth by income quartile showed that those lower income individuals are finally seeing wage growth begin to slow. And that's important because those are the individuals with a higher marginal propensity to consume. They spend every dollar that comes into their pocket. So that's really what can cause the delta when it comes to things like growth and inflation.
Peter Scheer of Academy Securities made this exact same point the other day, but he went on to say that his concern is that the Fed is paying attention to the headline data, that the Fed is reacting to data points that might be skewed. Do you share that concern?
I think that the Fed does a very good job of looking at a broad mosaic. I mean, they have a staff of economists that are spending time on all of this stuff. Yes, they're not going to fade the 250 number because there could be a signal, but it could also be noise. And so I think they'll continue to just look at what the data more broadly is telling them and try to square that with their own forecasts when coming up with the appropriate trajectory for monetary policy.
If the data is so noisy, should we just do what Mohamed El-Arian told me to do ages ago, which is listen to the CEOs? This morning, BP cutting 5% of the workforce workforce. Yesterday, we had headlines from Microsoft, from Meta, from Southwest. Are these idiosyncratic, or is there a trend?
I think for the time being, it's somewhat idiosyncratic. You know, the calendar turns, beginning of the year, a little bit of cleaning out the closet, if you will. But I think we need to watch these developments quite closely. And again, you know, coming back to the quits rate, part of what gives me comfort about the labor market is that the quits rate is low, but the layoff rate is also low. And if we begin to see that trend higher in a more material type of way, that's when I think you may see the Fed begin to express a bit more concern about the growth side of the equation and fade some of the inflationary pressure.
We won't discuss return to office policy, don't worry. David, it's good to see you. David Libowitz there, JP Morgan. David, thank you. Good to see you, mate. Equity futures on the S&P positive by 0.2%. A little bit later this morning, 7:30 Eastern time. Numbers from Morgan Stanley. After that, 1 hour later, we'll get some more data for you. We will have jobless claims and retail sales. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden gave his farewell address to the nation from the Oval Office last night. The president used his speech to hail his accomplishments, like negotiating a Gaza ceasefire deal and a sweeping infrastructure package. He also delivered a warning about the upcoming administration.
Today, an oligarchy is taking shape in America of extreme wealth, power, and influence that literally threatens our entire democracy, our basic rights and freedoms.
Biden will attend Trump's inauguration on Monday. Meanwhile, Taiwan semiconductor shares are up in the pre-market more than 4% after reporting an upbeat outlook. The chip maker's projected quarterly sales came in above expectations, and it says it plans to spend more on technology and capacity in its current quarter. This comes despite uncertainty between U.S. and China trade relations under the upcoming Trump administration, and Taiwan caught in the crosshairs. Meanwhile, shares of Richemont are soaring in Swiss trading after sales surprisingly jumped 10% over the holiday season. Analysts had expected gains of less than 1%. The sales largely coming from strong demand for expensive jewelry like Cartier in the Americas and Europe, offsetting weak watch sales. The news boosted shares of other key players like LVMH and Hermes. As optimism grows, the worst may be over for luxury. That's Bloomberg Brief. John?
Hey, Yahara, thank you. Big rally for the luxury players over in Europe, listed in Paris, France. Up next on the program, Trump's pigs facing a grilling on Capitol Hill.
I will fight every day to restore confidence and integrity to the Department of Justice.
We are once again called to create a free world out of the chaos, and this will not be easy.
That story up next, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
equities right now positive by 0.2%. Numbers from Bank of America pretty good. That stock is rallying again this morning. More numbers in just a moment from Morgan Stanley. Those numbers drop at 7:30 Eastern Time. Under surveillance on Capitol Hill, Trump's picks facing a grilling.
I will fight every day to restore confidence and integrity to the Department of Justice and each of its components. The partisanship, the weaponization will be gone.
We are once again called to create a free world out of the chaos. And this will not be easy. And it will be impossible without a strong and a confident America that engages in the world, putting our core national interests once again above all else.
So here's the latest this morning. Attorney General nominee Pam Bondi and Secretary of State nominee Marco Rubio among Trump's picks meeting lawmakers on Capitol Hill. Today, Treasury Secretary nominee Scott Bessent will face the Senate Finance Committee and is expected to talk about a, quote, economic golden age under incoming President Donald Trump. Joining us now to discuss, Jessica Taylor of the Cook Political Report. Jessica, welcome to the program. How easy will Scott Bessent have things later this morning?
I think he's going to face tough questions from Democrats, certainly, especially about tariffs and the Trump tax cuts and things. But I think they'll probably center on some of his background and things. But he is not overall a controversial pick. He's going to be easily confirmed probably with some Democratic support. But this is not one of the, high-profile controversial nominees that Trump has made.
It's high profile for our viewers, though, to watch and try to understand potentially some color about the policies we can see from Trump 2.0. When it comes to potential fiery exchanges in this hearing, which senators exactly are you going to be looking for?
I mean, I think Elizabeth Warren is top of the list, just given her, opposition to sort of Trump's worldview on things. So I think I'm looking to her particularly, and but I think Republicans are going to have his back certainly. And remember, he's someone that's also donated to Democrats in the past. He has not been. He's certainly come around to Trump's economic worldview, but he's not someone that's been in Trump's inner circle either as well.
True. Neil Dutta has reminded our audiences before, this is an individual who has had the temperament to work for both George Soros and Donald Trump. Okay, so let's broaden it out to potentially some of these other cabinet picks. Who do you think is going to be most difficult to get Senate confirmed?
I mean, I think at this point it might be Tulsi Gabbard, but even she looks like she's probably on the path. I mean, at this point, I think probably all of them have to be favored in that regard. We had Pete Hegseth's nomination they had the very contentious confirmation hearings, but still not as contentious as I expected it to be on Tuesday. And, Joni Ernst came out saying that she would vote for him, a senator that we were watching, given her past history in the military and especially past history of sexual assault. And then notably last night, John Curtis, the new senator from Utah, also said that he would vote for Hegseth. So with those key Republicans coming out for him, it's hard for me to see how he gets 4 Republicans that would oppose him. Even Gabbard, now that she has switched her position on, some of the surveillance, specifically Section 702 and different things you have, particularly John Langford in Ohio that came out over the weekend saying he would back her. It might just be, remember how rare it is. We haven't seen a nominee since John Tower in the George H.W. Bush administration that is voted down on the Senate floor. Typically, these nominees, the writing is on the wall and that they withdraw in the same way that Matt Gaetz did. And it's not uncommon to have a president that withdraws. Typically, everyone has someone that they end up withdrawing for various reasons. So it might have been that the Gaetz pick was that one. And I think when you put forward someone like Gaetz, someone like Pam Bondi, that in another world might have been more controversial. She comes across as much more palatable to Democrats because I think they're thinking, well, we could have had Matt Gaetz in that instance.
When it comes to the actual votes, when they take place, which senators do you think would be the ones that potentially could say, you know what, I'm just not going to vote for this individual? Republicans.
Yeah, I mean, the 2 key moderates that I'm watching are Susan Collins of Maine and Lisa Murkowski of Alaska. Collins is up for re-election. She is the only Republican running in a state in 2026 that voted for Harris, and then also voted for Biden in 2020 as well, and for Clinton in 2016. You know, but she won re-election in 2020. Remember, even as Biden carried her state, and Republicans, I mean, Democrats are struggling to kind of get a top tier. It's very early, but a lot of their key Democrats are probably going to run for governor and maybe not for Senate. So she's less susceptible to a primary challenge, which is sort of the key motivating factor. I think, you know, against someone like Ernst, that if she might have voted against them, she's also up in 2026. Already had Republicans, including some very conservative leaders in Iowa, that were talking about running against her in a primary. Lisa Murkowski is also a little bit unencumbered because her state decided to keep ranked choice voting. They have an all-party primary system where the top 4 candidates advance, and then then they're chosen based on ranked choice voting. So she's also not susceptible to a primary challenge. I'm also looking at Mitch McConnell. He's not the Republican leader anymore. You know, he does not share Trump's worldview, particularly on foreign policy and different things. And it's widely expected that he is not going to run for re-election in 2026. So he also does not sort of feel this pull. And especially as leader, he doesn't have to sort of have those relationships in the same way. John Curtis, I mentioned of Utah, he's another one I've been watching, and it was, again, very key when he came out for Hegseth. What does he do on Gabbard? Remember, we still have Kash Patel coming up for the FBI. Todd Young is another person from Indiana. He did not endorse Trump. He's been sort of more MAGA skeptic to Trump world. And then when it comes to, for instance, RFK at HHS, the chair of the Help Committee, Bill Cassidy of Louisiana, he actually voted to convict Trump in his second impeachment hearing. He's already getting primary challengers in Louisiana. Now, when he was last reelected, Louisiana had an all-party primary, so he was a little bit more inoculated in the same way that Lisa Murkowski was. But they recently changed their laws, so he will have to run in a traditional primary that he's never had to before. So he faces a real primary threat as well in 2026.
Jessica, when it comes today and what we're likely to hear from Scott Bessent, we know a lot of the questions will revolve around tariffs. From what we hear from him, how influential do you think Scott Bessent's push will be to Donald Trump when it comes to setting tariff policy, or will it all be about what Trump wants?
I think that Trump has surrounded himself with loyalists, and Bessent has become that, I think, you know, but I think he also brings sort of a broader worldview in sort of the financial world than Donald Trump has, and sort of these nuts and bolts of the financial world. So, you know, I do think he will be influential in that regard, but I think Trump also has someone, he's picked him because he has this experience, and I think that is broadly appealing and reassuring to a lot of senators, but he is someone that has come around to Trump's view, particularly on tariffs as well.
Hey, Jessica, appreciate your time. It's good to catch up and hear from you. Thank you. Jessica Taylor there of the Cook Political Report. I think can make the argument the most influential person in all of this, the Treasury market. Mr. Bond Market, Mrs. Bond Market is going to have some things to say potentially. They want to run this economy hot, and they will, so long as fixed income in this Treasury market allows them to.
This is something Scott Bessent knows extremely well, too. Last January, in a letter to investors in his hedge fund, he basically wrote that the only thing that can stop Donald Trump and the exceptionalism of an economy under Donald Trump is high long-term yields. He is acutely aware of that, and that also might color what he says today.
Definitely, and this is something that it's not just Scott Bessent that's watching. I'm still taken aback that J.D. Vance, soon to be vice president,
quoting 10-year bond yields
on Fox News Sunday morning program. It's pretty exceptional, and you have to think this is where they're focused on.
You know what Brammer would like? To take bond auctions mainstream. She'd like to see that mainstream. We'll see if we can make that happen. Equity futures right now in the S&P positive by about 0.1%. Up next, we get some results from Morgan Stanley to round out the numbers on Wall Street.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
So far, so good for the earnings on Wall Street. It kicked off with JP Morgan yesterday. JP Morgan numbers, really good. The outlook, even better for Goldman Sachs. Fantastic trading figures. For Bank of America, the investment bank, looking better than good. For Morgan Stanley, we'll get those numbers any second. And we'll see if we can get a clean sweep on Wall Street. Equity futures on the S&P 500 shaping up as follows. Futures positive by a little more than 1/10% on the S&P. On the Nasdaq 100, we're up by 1/3. On the S&P, a 3-day winning streak. And yesterday, on the S&P 500, on the Nasdaq and the Russell, the biggest one-day gain going back to the post-election bump on November 6th. That's the equity story. Here's the bond market picture. 2-year, 10-year, 30-year. On a 10-year Treasury yield, yields are up by 2 basis points. The yield right now, 467.77. A little bit later this morning, we get some data. Jobless claims and retail sales. Then after that, a hearing on Capitol Hill with the Treasury Secretary designate Scott Bessent and some big questions, Danny, about what he's going to do with this Treasury market.
It's going to be very crucial to the shape of this curve because he has been really critical, along with the likes of Nouriel Roubini and others, that Janet Yellen didn't term out the debt, that too much of the debt has been concentrated in T-bills. So him and his past remarks shows a willingness to do that, to issue more longer-term debt. But at the same time, Scott Bessent is very aware that longer yields, higher yields are a bad thing. So how does he strike that balance? Is he able to issue longer-term debt, but also keep yields at a ceiling?
And also, how does he handle the debt ceiling? This is going to be a massive fight on Capitol Hill, and it should have been, for many Republican voices, dealt with in 2024. Clear the decks before 2025. It wasn't. This is going to be a fight, and I guarantee they're going to ask him, do you think we should just get rid of the debt ceiling? What I would say, though, on issuance of debt, because Scott Bessent has taken a lot of aim on Treasury Secretary Janet Yellen about this, it is easy to criticize from the sidelines. It's going to be hard when you're in the chair.
Things could change a lot in the next week or so. I think a lot of people taking comfort, for good reason, from the bank earnings we've seen so far, from the inflation figures we saw yesterday, that softer CPI print, also softer PPI as well. But that can all change on Monday morning when we get the inauguration. And then later on in the evening, you start to see them gear up to release a load of executive orders, and the focus shifts quickly, maybe to trade, perhaps to something else. Who knows? Let's turn to this in foreign exchange. It will also have implications for other central banks. The BOJ and our reporting suggesting the BOJ is gearing up for a rate hike here. Dollar yen's down to 156.13. And really the only outstanding question for the Bank of Japan, it's not even the data coming out of Japan. It's what happens next with the policy of the incoming administration.
You can't help but laugh because it's almost a ridiculous place that they find themselves in, that just days before their meeting, they won't know what they're doing until they get some executive orders coming down. Look, for all of the criticism that the Fed is too reactive, you have a Bank of Japan that's not even reactive to their own data, but is reactive to American data and U.S. politics. It's a necessity. And you could argue that in America, it's a necessity, too, that the Fed needs to understand what fiscal policy is going to look like before they set their agenda for the year.
Policy and the political economy will be the driving force for markets in 2025 and for, clearly, central bank leaders. What does everyone always say? The Fed is the global central bank. for the world. The Fed is the central bank. Well, then what does that make Donald Trump?
The president of the world right now and dictating a lot of policies in a big way. In the next few minutes, any moment now, we'll get some numbers from Morgan Stanley. When they break, we'll bring them to you. I want to start with a few other stories, though. Under surveillance this morning, Israeli Prime Minister Benjamin Netanyahu accusing Hamas of walking back conditions of a ceasefire. His office saying new demands are an effort to, quote, extort last-minute concessions. The Israeli cabinet won't gather to approve the ceasefire until Hamas accepts all terms.
I would say a lot of this potentially is internal politics. And I also think, given the fact that these are a state of Israel with Hamas, which is designated a terrorist organization at war, you can imagine there are going to be a lot of stop and go, starts and stops when it comes to this. Right now, though, this deal is holding, and this means 33 hostages, including Americans, will be released starting this weekend, and I've been told 24 of those hostages are alive, Jonathan.
I mentioned those numbers coming from Morgan Stanley. They drop right now. Let's cross over to Manus Cranny for more. Manus, you're poring over these figures. What do you see?
Beats are a beautiful thing, Jonathan. Wealth management, the core in this number is 7.5 billion. The market was looking for 7.3 billion. Fourth quarter net interest income, 2.55, 2 nickel. The estimate out there was for 2 billion. Again, adding to the sweep of beats on net interest income and guidance. So net interest income, 2.55 billion, way above the estimates. Also keeping a check on expenses. Compensation expenses, to be precise, 5.95 billion, below the 6.64 billion that was estimated. Jane Fraser had that battle on her hands at Citi in terms of reorganizing it. But this is a beat on wealth management, a beat on expenses, a beat on net interest income. Provision for credit losses slips to $3 million. This is an economy that is strong, that is on fire. I'm just trying to check for the advisory side of the business as well. Haven't quite got those yet. But Jonathan, on first sweep, there's a very comfortable beat on a trifecta of issues for Morgan Stanley.
Manus Cranny, stay close and I'll come back to you. Bear in mind that this stock rallied yesterday by almost 5%. The read-through coming from Goldman Sachs' numbers, which were pretty tremendous. Morgan Stanley's up by 1.4% in the pre-market. Shnali, did we get our clean sweep on Wall Street?
We got more than a clean sweep. I mean, if you look at equities trading at Morgan Stanley, I had to look 3 times because it's at $3.3 billion. The estimate was for $2.6 billion. So they're coming in almost $1 billion more than expected. And not to mention, they're coming in $1.3 billion more than JP Morgan. So they are just under Goldman Sachs. This is that heated competition under the surface I was talking about. This was Ted Pick's home court. So they're showing that on the core Wall Street businesses, they are just slamming through the roof. And in addition to that, the margins for wealth management are also very strong. They're coming in just about as expected, even a little bit higher, while keeping compensation expenses under control, making more money and delivering more profit back to shareholders.
Can we go back to one of the numbers that Manus mentioned? That, again, is another theme with these banks. Provisions for credit losses were $3 million. The estimate was just under $74 million. That is so much less set aside. Yeah. What does that speak to, not just credit quality, but the risk that these banks are taking on at this moment?
Really important, I think, here is to recognize that Morgan Stanley and even Bank of America at this point, they're lending to wealthier consumers. The credit quality is not going to be as tough as we see later in the earnings season. One that I'm looking out for, Ally Financial. Even Carvana, right? I mean, you have to look at what's happening in autos. You have to look at what's happening with FICO scores that are not 800.
That feels like a lifetime ago when Ally Financial came out with a warning.
Right.
How long ago was that?
Last quarter. I mean, it was during the end of last year.
It feels like years ago since that happened. It feels like this market and this sector has moved on pretty quickly since then.
However, there's a bifurcation, and that's why we have to keep watching what happens through the next couple of weeks. Do the smaller banks and smaller lenders come out as strong as these mega banks? Yes, fine. They're making a lot of money at the higher end. They're making a ton of money on Wall Street, businesses, trading, investment banking. Does that look the same? Is loan demand going to be as strong at some of these other firms when people are already maxed out on their credit cards?
So maybe you can't extrapolate it to some of the regional banks, especially when you don't have some of these trading wealth management businesses. For Morgan Stanley and wealth management, we go back to the Goldman thing we talked about yesterday, the fact that they're pouring into private credit. As they manage these businesses, what business model makes sense for Morgan Stanley? How are they achieving these sorts of numbers when all these banks are flocking to this area?
You know, there was this great story in the Financial Times at the end of last year. People might have been on vacation and missed it. This whole thing about how Ken Moelis
Oh, I actually did not mean to shade you on that one. But you were on
me for taking
vacation.
vacation.
She looked at you when she said that.
Am I on vacation now? Is this a permanent vacation? Continue, please.
Well, what people have learned is that this capital markets banker, the conception of that is really the future of Wall Street. And you could see it all the way at the top of these firms. Ted Pick, capital markets. David Solomon, capital markets. Goldman Sachs, new capital market solutions.